Boom goes the dynamite. It's Monday, March 24th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan as we wrap up the trading day. Futures market closes at the top of the hour, 55 minutes from now. Come tell us what you're talking about and trading today. Come over to the YouTube channel, chat with us. Tell us where you're from, what's going on. If you're already there, come over to tastylive.com, the website, see what we're all about. Of course, the platform Tasty Trade. Ladies and gentlemen, it was a good day for stocks. Tariffs on April 2nd are going to be narrowed. No tariffs on autos, no tariffs on semiconductors. It's a good day for those tech stocks. NASDAQ here up around 2% or so. S&P up 1.68%. Dow Jones up by 1.39. And the Russell is your leader up 2.44. It's likewise a good day for crypto. Bitcoin up over 5%. Bond sell-off, not just the tariff news, but some pretty good economic data this morning. The S&P Global PMIs beat expectations. Ilya has a lot to say on that. Gold and silver down a bit in this environment where risk-taking is flourishing. Mixed market for currencies, and the dollar may be putting in a short-term low. We'll talk about exposure and more there. Guys, we have some time to talk through this week, a week in which earnings are light, the macro calendar is thin, but markets are moving. Ilya, stocks are rallying. You were dutiful in your short exposure, riding the whole thing down and basically getting out the low. You've been very patient in trying to reacquire some new short deltas here. And I think that patience has served you well. So now after a 4% move off the lows, is this the end of the correction, or is this just setting us up for a new opportunity to potentially get short?
I think there will be an opportunity here to get short, and this is not it. From the looks of it, there's more wood to chop, as you might say. There's more upside, it looks like. The next inflection point I'm looking at is the underside of those lows from January, where we carve out that range. We peak in early December, then kind of in a choppy fashion stair step down to those lows from just the beginning of this year, kind of mid-January or so. That takes us to somewhere over there, and sort of the closing lows around there make for a bit of a range between, let's call it, sort of 58.60, 59.20.
Sure.
Kind of 20 points around 5,900, 40 points around it, something like that. Support and resistance are very rarely aligned. They're usually a sort of area of fuzz. And so somewhere over there, I think would be interesting to look for opportunities if the market decides to stop there. If it doesn't, it can, of course, not and go all the way up and hit something like 6,000. And that would still not be, in my mind, a change of course. It would just be a deeper retracement. I think you really have to do quite a lot of constructing here for this to make sense as a longer term buy, which is not to say that a tactical long position is something that I think is unattractive. For me, it's more the pricing. We were talking about futures on Futures Power Hour earlier today. However you price along here, whether it's you're buying a call spread or you're selling a put spread, you're sitting on basically one-to-one risk reward with less than 50% probability of profit. That just doesn't make sense. It's not risk reward that makes any sense. And so for me, I'm not opposed to buying if there is a further vol crush, say, and we don't run away from current levels and the pricing gets more advantageous. Otherwise, you wait, you get to where you're going to go. As you go higher, the vol is crushed, and you're now buying puts as a directional short. That's sort of my idea. If the market lets me into a tactical long, okay. But if it doesn't, the longer term idea is to wait, let it get to where it's going and sell there.
Dylan, last week in the face of all the fury and bad press around a name like Tesla, you were down in the foxhole selling puts. It's an 11.9% rally in today's session. Is this a sign that the worst of the broader equity market sell-off is over, or was that just a hysterical market?
I think it's a sign that Donald Trump and his tariff madness is driving this entire stock market right now. And if it's, tariff madness in the worst way, the market goes to hell. And if it's tariff madness in a lesser way, the market rebounds. And I just think that Tesla is purely a derivative of Musk himself, Musk's relationship with the government, and the perceived consequences or lack thereof of tariff madness. I think the only real question is what's going to happen on April 2nd, which has become the new cliffhanger date for the Trump administration, who loves to set up cliffhanger dates. And I think you could make a case that there's going to do nothing on April 2nd based on historical behavior, that they're going to create the appearance of doing lots of things on April 2nd with tariffs. And then midnight on April 2nd will happen, and it'll be the last second reprieve is like one of the signature gimmicks of the Trump administration.
It's almost a trope now.
Yeah. It's like the Dukes of Hazzard. Like, will they get him this time, Charlie? I don't know. And then they got away again. I mean, it's that stupid at this point.
Can I point out is the market interpreting all this news correctly? You see it breaking, and I'm intentionally leaving this in the lower panel here just for the sake of effect. Deal with this for a sec moment. Dow jumps nearly 600 points on Monday as investors hope Trump softens tariff stance. The article that's on the front page of CNBC right now, right, if we were to pull this up, from 2:50 p.m. today, 2:50 p.m., Trump pledges auto, pharma tariffs in near future. In the press conferences in which he says they're pushing back the reciprocal tariffs on April 2nd, that there's going to be, some countries may give a lot of countries breaks. He still says that autos are going to be announced thereafter. Pharmaceuticals are coming. Semiconductors are coming down the pipeline. The market just ignored this completely.
Well, maybe that's just not the current episode. If the reciprocal tariffs are the episode we're currently watching, and that reprieve has come, then that's the next episode. But the arc is going to be the same because the arc is always the same. And so we'll get the reprieve at the end of that arc. It's like a Pavlovian response almost.
It's just an interesting dynamic where the market gets reports yesterday over the weekend, Wall Street Journal, New York Times, Axios, that the reciprocal tariffs are going to be pushed back or narrowed in some form or fashion. We have a press conference today, straight from the horse's mouth, saying that, there might be an April 2nd deadline that we carve some things out of, but the tariffs are still coming, folks. I don't know, Dylan, that to me says that we should be very careful if we're operating on the long side, if only for the other side of this, which is the yield response has been for higher yields the past few sessions, and we're pushing to topside levels where in recent days when we've seen yields bump up above like 4.3%, someone in the administration comes out and says something that ultimately jars market participants into maybe double thinking their stock exposure and wanting to get long bonds again. Ilya, do you think that the put has shifted back to SPY from TLT at this point? If one of our theses here, not just between the three of us here in Overtime, but as discussed with Victor Jones, Tom and Tony, right? The Trump put is not in SPY, but TLT. Is it shifting back to SPY at this point?
I don't think so. I mean, I don't think there's any indication that you've heard from the administration that necessarily that's the case. I mean, you haven't had a run in yields really to the upside. You're basically stuck in what is a range, and yields have come in. And ostensibly, that's what the administration is targeting. They want lower yields at the longer end of the curve, perhaps because the endless whine from some circles that we didn't term out the debt enough. We did term it out quite a bit while the rates were low, but that we could have done much, much more and really termed out the debt into the decades. And that would be a good thing, which, if it were possible, why not? So it seems like this administration specifically wants to do that. And you and I were talking earlier, if anybody would understand how to spook the markets into lower yields, it would be someone like a Scott Bessent, a macro hedge fund investor that would understand sort of how the markets need to receive information and what they need to receive to spook yields and essentially strong arm the Fed with circumstance into cutting. So when you get some kind of a move here, ostensibly you get a response. If yields were to start to build higher in earnest, we might have to come up with a tariff headline or two or some such thing, if this is in fact strategy.
What's the strategy here, Dylan? Just to do a quick vibe check, is there any master plan? Are we still looking for that North Star on trade to find a direction?
I think you have two lines of thought here. One is the Captain Crazy Pants and his tariff war. But the other is which is very unreliable, could go any which way any given day, and all the things that we know. But then you also have a more reliable sense of slowing economic activity, full stop, whether it's the sentiment here, the advertisers this, consumer discretionary. I do wonder to the degree to which you do get a meaningful rally here as a result of perceived short-term tariff relief, if the opportunity is actually still on the Ilya's side of the ledger to the short side, or to if the underlying reality is a slowing U.S. economy, full stop. And maybe the catalyst for the slowing economy is some of the craziness. Obviously it's a component of that. It may not be the only factor. It's probably not the only factor, but and so you kind of have to pick your spots. I think from a trading standpoint, that the Trump administration's economic policy is so volatile and changeable that if for those with the courage, I think it creates tremendous opportunity. To sell puts in Tesla, it was great, but for me that was real pure There was nothing. That was not a calculated risk, other than maybe the odds of how many how low can it go, but it felt more like straight gambling basically. But I do think that the advantage of the Trump administration and its economic policy is that it provides big swings in liquid assets almost every day right now, driven by some piece of rhetoric. And so, I guess I wonder what I'm thinking is if you could really make a living trading against the same way there's you always buy whatever Nancy Pelosi is buying, or you always do the opposite of Kramer, or you always last year were selling oil on fears of World War III. Like when the market does whatever it does, like today it rallied on tariff relief.
Ostensibly.
Ostensibly. So maybe you sell, maybe you get a short, little lighten up here. Then it's going to get blasted at some point on tariff fears. I just don't know how reliable that is, but it's looking increasingly reliable, actually.
For what it's worth, if you look at the specific timing today and you say, well, what time in the day today did the S&P sort of make its run? And you start to, obviously it starts last week. We get a little bit of a lead on Friday. But if you look at where the actual kind of meat of it starts today, it is at a very auspicious moment. It's exactly at the time that you get those PMIs today. I mean, almost to the minute. And so it front runs them a little because those PMIs do tend to come out on the Reuters terminal before they come out elsewhere, last I checked. So you can get a little early action, as it were. But you get very clear signs that, oh, well, the economy is not that bad. And the Fed already told us last week that if things were to get dicey, they would come riding to the rescue. It just needs to show up in the big and important data. And so, again, you sort of come back to when's the big important data? Not for a while. And so then what's the path of least resistance?
It's a good question. I mean, I still have my short put spread on an ES, so hopefully the path of least resistance is to the upside right now. At least
it certainly seems that right. way. I mean, I think there's just nothing to tell it not to do this,
not to drift higher.
Yeah, well, because the stock market we know is biased higher. Right? The stock market doesn't want to go down. This is not a two-way asset the way oil is or the dollar is.
Sure.
Stock markets like going higher because a ton of its large participants, be it pensions or endowments or whatever, they never sell. They're always long. They only buy more. So you have a thing here that sort of structurally favors the upside. So if you leave it with nothing but a Fed that said it's okay, we'll come fix things if need be, and nothing particularly new from DC, and data that was not bad, but actually sort of meaningfully better than expected, at least from the outset. Once you get into the weeds, it's dicier, but at least at the outset, better than expected at the headline. Why not?
Guys, it was a pretty good day all around here. We look at our FinViz heat map. Tech leads the way. Consumer cyclical up, communication services up, financials up, industrials up. I mean, everything was pretty much up today. The only things that were down were gold miners, junior gold miners, GDX, GDXJ, and utilities, XLU, which is only up by 0.03. And then you talk about the weakest winners. Staples, healthcare, energy, all underperformed the broader market. This market was led by consumer discretionary. XLY was up 3.75% today. XRT, retail ETF, up 3.39%. XTL, telecom, up 3.24%. Telecom, to me, is fascinating because we looked like we were putting in some sort of big distribution kind of top here, and now we're back into that range. There are some signs of the market turning around a little bit better. Sector rotation is perking up. Financials never really broke down. This is looking like a very long multi-month bull flag at this point, Ilya. There may be some juice here to the upside before we ultimately see things top off. I'm just curious as to how we reconcile Trump's comments this afternoon late in the day with the news reports over the weekend. So, I mean, Dylan, I think you just provided actually really valuable insight. The object of speculation right now is April 2nd. Once we get through April 2nd, the game clock resets. We have a whole new host of concerns. What tariffs are going to be here? What tariffs aren't going to be here? What's the cliff date that we have to start to worry about? It almost seems like there's kind of a rhythm that's happening now where the market is weak in like the 2 weeks after the date is announced. And then like the 10 days before this cliff date comes, the market starts to rally again. Because it's like, oh, wait a second. He's going to blink.
No, that's why I'm starting to wonder if this is actually becoming as predictable enough to be useful.
We started at the beginning of the year wondering if it was Boy Who Cried Wolf, right? We had 6 weeks of Boy Who Cried Wolf. And then you had a bad 3-week stretch in late February, early March. But now it's like with today's action, okay, yeah, you've already told trading partners what tariffs aren't going to be there on April 2nd. So you can say what you want in your daily press conference. Just we know what you're going to do. Watching what you're doing, not what you're saying. Okay, I guess that's the world we're back in. Ilya, it's not just the tariffs, though. Let's talk about those PMIs. Bonds notes take a significant leg to the downside. here today. We have the S&P Global PMI come out. This is the report on February 21st, by the way, that kind of kills the market.
Yes.
Recession concerns running high. We now see that after the revisions, coupled with this latest update for March, we're back in expansion territory. There are good signs, there are bad signs. Just talk us through the data and why this helped the market today, at least in stocks, and hurt bonds.
Sure. So let's first contextualize this a little bit. So over the course of January and February, you got some real weakness, and it was coming from the service sector, and it was mainly something that was, if you read the reports on the S&P Global website, has them available, and we've, of course, talked about them at length. A lot of it is sentiment-based concern around tariffs and fiscal policy more generally, and the economic direction of the economy, and just overall uncertainty, and a pulling back on capital expenditure, on hiring, just a cooling off in business, saying, listen, we don't know what's going on, so we're not going to deploy capital. Let's let this dust settle. And what you see this month is a pickup in the service sector, welcome rebound here. This is the fastest service sector growth that we've seen since December. So not the kind of scary readings we got in January and more so in February. Then the composite index rebounds. That's the fastest growth since December. The service sector, on the other hand, slumps back into contraction territory. And that sort of lines up with what the PMIs have been writing as it was improving over the past months, saying this isn't a real improvement in the manufacturing sector. This is front running of tariffs to try to buy as much inventory as you can before the price on your manufacturing inputs goes up. And ostensibly, it seems like that process hit something of a wall in this most recent report. Now, what's not great here, because of course at the headline you go, oh, whoa, wonderful, service sector rebounded. But if you go to the very top of the PDF you're showing there, and you look at the overall chart, the S&P Global PMI chart there in the second column, you can see, yes, you've rebounded, but you're still not back to the growth that you had really very steadily predominating last year. And so you kind of have to ask yourself, this is a diffusion index. It's not telling you the level of growth. It's telling you whether the growth is positive or negative, and then giving you a sense of pace. So in the previous 2 months, you had the slowest pace of growth in years. And so like 15 months, so let's call it approaching a year and some change generously. Are you not going to see an easing of the pace just dynamics-wise? Of course you are. And so this is perhaps not as encouraging as it appears. You do have to look at the underlying, and that's exactly the chart here, confidence in services, future demand expectations for services and the whole cratering. And that's not what you want.
Cratering while prices are starting to show signs of flashing higher within these indexes.
That's right. And so you get this sense that you have a certain relief in the rate of change here, not necessarily in terms of where sentiment actually points as you get inflation up. And so under the surface, as we were saying, it's not all that great. At the surface, though, it's enough relief to say the Fed is not off sides if it waits until the May meeting to reassess again.
I think the summary here is worth noting. They see growth at an annualized 1.9% rate in March and 1.5% over the quarter as a whole, which again, we've covered the Atlanta Fed. The Atlanta Fed right now, bless its heart, it's my favorite GDP tracker. They've had to point out that because of how they calculate trade, gold imports having surged through the roof is creating this huge albatross around the overall GDP tracker reading. And if you were to back out the gold import figure that's distorting everything, you have growth that's closer to 1% annualized, which is not recession. It's certainly a step down from the 2 to 3% real growth that we were seeing previously, but it's not recession, right? And recession is what the market's been fearful of. So we take a step back today. Tariffs not necessarily coming in full force. Even if they're coming, we have data that shows that the economy is certainly seeing a little bit more stress. Confidence in the future is falling. Input prices are rising in the short term, but business activity continues, at least for now. So relief, no imminent recession, despite data pointing to that recently. There's no volatility here, though, right? I don't know. So going back to the trade now, I have long deltas on in ZN and ZB, right? Being short a put spread in ZB today wasn't the greatest thing in the world, vol crush, but price goes down. In being long calls in ZN totally sucks, right? Vol comes down and price goes down. That's not what I want. I want to see vol expand and price go up if I'm long the calls. But the underlyings of that PMI report, Ilya, do not tell a promising story about which way the future is heading. Even if we've warded off a potential downturn in growth for now, the conditions remain. Is it cheap right now? Guys, do you see a negative 0.2 IVRs? Hey, why not get some cheap out of the money exposure, long dated, put it in the pocket in case something hits the fan. And this week, a week without that many catalysts on the macro calendar, on the earnings calendar, it could be a tweet that sends off a tumble in stocks just as easily as we've seen today's gains come about.
I'm already a little bit long via a TLT call vertical from basically here. And so I'm looking at these IV readings and I go, maybe I should term myself out now while it's cheap and just put a bunch more duration in it.
Dylan, do you have any strong feelings on bonds?
I mean, my only thing is whether the oil rally presents an opportunity the other way, because I think the economy is slow and slowing. Mm-hmm. And I think oil is absent lots of geopolitical stuff, which seems to be less relevant to oil at the moment. I think oil is a nice proxy for quarter to quarter economic activity. And I think this little bump higher, it certainly holds my attention. I'm curious, Ilya, why the TLT long position of everything you could kind of do around here?
Well, so I think that ultimately the path is for lower rates. I think the slower economy is that. I think the administration wants that, so it's helpful not to fight them as ever. I think all of this sort of points to, in the best case, the Fed cuts as much as they've said, but if the economy is going to evolve as it seems to be, they're going to have to cut more. And the longer they delay, the more of those cuts are going to start to get speculated into the back end of the curve. And if they really delay and something really goes off, then bonds are going to rally on haven demand. So in the best case scenario where you get the soft landing and everything turns out okay on tariffs and growth, there's the regular rate cuts. At the other extreme, there is risk aversion and sharply rising bonds and collapsing yields. And in the middle, there's a garden variety recession, nothing scary, just the usual business cycle where you get the regular kind of repricing for more Fed cuts, and again, more at the long end. So just seems like you have an uptrend in bonds since the beginning of the year. You've settled back to where support is. You're holding that support. Doesn't seem to want to go under it. That feels like a buy.
I mean, I just can't get a read on crude. I suppose the longstanding research holds, though. If you, at any point over the past year, if you looked at the current price and said, all right, I don't think we're going to trade, higher than $10 not aside of this, you've done pretty well for yourself. The best predictor for crude prices at any point over the next 12 months is, in fact, the current spot price. And this has been just a choppy, range-bound market. So maybe we see some acceleration here. I feel like this is all one trade, though, to take a step back. The rolling one-week correlation between oil and bonds right now is negative 0.61. The rolling correlation between S&P 500 futures and bonds, that's negative 0.78. To me, it feels like if you're worried about recession, you're short oil, you're short stocks, you're long bonds. And if you're no longer worried about recession, you're going to be long oil, long stocks, and short bonds.
Mm-hmm.
And so then from that point of view, I'm going to make the case that we are at the turning point in this market right now. We see here in crude the downtrend off the highs from January, from February, the 618 retracement of the 52-week high-low trading range. We crossed through there. We're in 69 or so. You break that downtrend. In ZB, we're dancing along the 1-month moving average, that 116.5 level. That's been support for the past few weeks. We're testing the uptrend off the January and the February swing lows. You could say the same thing for ES here. In fact, I'm going to make a case and go to SPX instead because it feels like we're just trying to poke through that level here today. This was the line in the sand that you and I drew last week on Futures Power Hour, Ilya.
Mm-hmm.
If stocks advance further from here, it's probably going to be alongside a further push higher in yields and a push higher in oil in the short term if we're unwinding any growth concerns. And on the flip side, if we see yields tank back and hold support here, right? If we see bonds and notes hold support here, if we see oil face resistance, I don't know how long this stock rally can go because it probably means that we're concerned about tariffs anew. So I'm going to stay long risk right now. I have my long deltas on in the S&P. I'm also going to hold my long bond positions. I just don't trust this move because the reasons for which we've rallied, given the information released over the course of today, seems like we could easily be down another 1.5% tomorrow.
Yeah.
Just because Trump's not happy with how the market did not pay attention to any of his comments this afternoon.
What's
totally
interesting
conspiratorial.
Is that,
I get it. Totally conspiratorial, but
what's interesting is if you look at where the markets have ended up at the end of last week relative to the Fed. So the Fed gave a bunch of fuzz around the growth, the inflation outlook, this, that, and then kept the actual numbers that everybody cares about, the outlook for rates, unchanged. 50 basis points this year, 50 basis points next year. Well, the markets have apparently heard. Because if you look at what's actually baked in now, it's 58 basis points for this year, 43 basis points for next year. Might as well be 50-50. On net, 101 basis points. The markets are off by a basis point. So we are at equilibrium, as it were. After the PMIs today, the market said, yes, the Fed is right. There is no emergency. Let's just wait. And in that kind of an environment, either it's a DC headline or somebody decides to care about PCE. Unlikely.
Good luck.
I will talk about it on macro money and why nobody's going to care and what that means, but I might be the last one. And then it's NFP next week, which basically means that over the next almost 2 weeks still, you don't really have anything to tell stocks to not go up, which is their natural inclination. And all you really need is enough room on the upside with enough vol crush to make it make sense as a buy. But then you figure going into that NFP number next week, by around midweek already, everybody's going to get collectively scared because they're not going to know what it's going to be and what it's going to mean. And that'll be the next big event risk. So figure from about now until the middle of next week, unless Washington decides to rain on everyone's parade, you have a window to correct. Seems like a time to just sit back and say, well, the markets and the Fed are simpatico. I'll be back when they appear to be at odds again, because that's where the opportunity is.
Dylan, Ilya's painting a picture where we kind of have blue skies ahead of us. Where are the sources of turbulence?
I give you 7 days.
Where are the sources of turbulence
all
this
he's
week?
doing is, I mean, the only turbulence this week comes from the broken record that is the White House. But that's not nothing.
That's
but in
right.
the absence of earnings and in the absence of macro data and coming off of this wicked sell-off the last month or whatever it is, you have to agree with Ilya's of sort of statistics. Odds are in favor of rallies, not sell-offs right now, just because there's not going to be a catalyst, but for the Treasury Secretary, Commerce Secretary, First Buddy, and the President. And so those four people kind of dictate what happens in the financial markets in the short term right now. And they're your primary, I wouldn't say risk, but I think they're the primary variable at this moment.
I really wish that wasn't the case. Like, I'm trying to find a catalyst or something that we could point to and say, like, oh no, we can worry about this or minimize that. But absent the other binary events, I mean, I guess it's really just DC or bust right now.
Because you don't have earnings, you don't have macro data. What are you going to, there's the absence of something else only amplifies the relevance. Maybe that's all this is a reason to get involved, get more optimistic for Ilya's, rally of the week. I mean, I guess if you're going to get a rally of the week, I think the parlor game is, where does it manifest most aggressively? The obvious answer would be somewhere in the Mag 7 or consumer discretionary, like where tariff relief is the most levered. I don't know I haven't looked at all those names today, but I'm assuming they didn't all go up as much as Tesla did today.
No, they did not.
I don't know
but all up all in the neighborhood of 3% plus. Amazon 3.5%, Apple, for example, 1.13%. But yeah, Amazon, you would think, Apple, you would think, would do well in a world where they can continue to import cheap trinkets from abroad and slap a healthy margin on top of them to resell to us.
As much as the markets love when the zeitgeist thinks it knows what the market is doing, it likes to turn the other way. So every story over the weekend was, oh my God, Tesla's stock is crashing because these yahoos are out there vandalizing all things Tesla like a bunch of fools. And the market goes,
so self-defeating.
Oh, you've figured it out. You figured out how the stock market works, huh? There you go. Don't write headlines over the weekend that awaken me.
And it's so funny. Over the weekend, I texted two of our former coworkers some headlines about XYZ happening, and it was like, oh, Tesla's going to be down 5% on Monday. And then I saw a Reddit post over the weekend of people saying, like, here's how you can benefit from Elon Musk's demise. Go to the June 10th expiry, click on the $125 puts, load up. And if enough of us do this, we'll all benefit together. Something along those lines.
Oh, here we go.
And it was like, oh, gosh, wait a second. Tesla's not going to be down 5% on Monday.
A sure slaughterhouse.
Isn't this the same guy who was posting about copper and the Olympic medals last year? Right? Like, that's the kind of vibe I got. So it's like, oh, actually, guys, check that. Tesla's not going to be down 5% on Monday. It's actually going to be up 5%. Yeah. That was also wrong. It was up 12% today. But Dylan, you've been an adherent, at least a believer in Apple, I guess vocally at other points over the past year when other people weren't. I think last year you were pretty vocal about the AI. We had the June Apple event, and then we talked about
mixed
AI
success, but yes.
But you were an early believer when the stock was trading at like 170, and you were looking for.
And Apple suffers in the tariff war. Amazon suffers in the tariff war.
There has been a turn here, though. This is just a simple parallel trend line that I've drawn here off the highs. Okay, But you could see here swing lows that we have in November and in January. We actually poked back through today. This looks like a decent low now that we have having formed here in Apple, which, again, given the event risk, it could be eradicated very quickly. Nevertheless, on a pure technical basis, this actually feels like a place where we could take a swing. First time that we've had a long entry signal on MACD going back to January 27th. You have a 37.6 IVR here. In absence of good volatility elsewhere, Apple actually is probably a prime target if this rally is going to continue to bounce here in the short run. Can I tempt you into making a long delta trade here, Mr. Radigan?
Yeah, you can. You can. I mean, it's. I just hate to do it because I feel like the only reason I would do it is because of optimism that the Trump administration is more bark than bite. Like it's a very Trump binary right now, more than anything else. And if I'm going to do a Trump binary, I think I'd rather buy Amazon.
Why is that?
Because I think Bezos is more friendly with the president, and I think Amazon is more affected by the tariff war. I think Apple's more of a luxury brand for the American consumer. I think Apple's more tied to both their own technology and then the sort of the health of the consumer discretionary spending. Whereas Amazon, I think, is more insulated from consumer discretionary spending. It's more consumer staple plus, but I think it's more affected by the Trump madness. And I think Bezos has gone out of his way to be a Trump, second buddy, third buddy, more than Tim Cook.
He's trying to.
He's trying. He's trying.
Yeah.
He's trying to get in there.
Yeah. He's like, they don't invite me to any of the events.
He's not on the list. He's trying to get on the list.
Amazon, if you're looking at something similar, the recent swing lows around 190, put spread 15 points wide. That's wrapped around those levels. 60% probability of profit, max profit 470 versus a max loss of 1030. There are ways to go out. This is 53 days to expiration, by the way, but there are ways to structure some opportunity here. And I know a few people will say like, well, why not last week when the volatility was 75? Dylan did it, right? This is just not my trading style. My trading style is momentum, turns. I am always going to miss the turn. Just how I am. I've accepted my fate as a momentum guy, right? So before you bark and say, why now? Well, because it was still in a downtrend a week ago. I don't have the Radigan cojones. Maybe in time. But yeah, I think there are bottom signs here. The Mag 7 ETF itself actually looks really decent. You have these former.
Maybe that's the best way to go about it, is this Mag 7 ETF with a call spread of some kind.
I've looked into this today. These are really, like, if I'm going out 53 days, I want to try to do this tasty time frame, 45 in, 21 out. There's just not a lot of volume or open interest in the relevant strikes. That's kind of the issue that we're working with here. If I wanted to go out, like theoretically, if I want to go out right now and do a short put spread here, if this were to work, yeah, but the total open interest in the contract's 20 and 32 at these two strikes. You never want to Hotel California your way into a trade, Mr. Radigan, right? You can get in, but
that's a critical point.
Yeah, and it's after hours here, but like look at the spread. If the bid is hard to borrow, we can go over to the liquidity indicator here, only 2 stars. Just on paper, good. Is it really? Can we execute it? Probably done better. You could actually structure this if we were to go out and, around all the recent swing lows, we could do some short put spreads in Amazon, Apple, Tesla, yada, 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 and structure a trade along those lines. Could work out individually, a little bit more risk than one may like. But there are things to work with right now, though. And I think, Ilya, tip of the hat to you, only because you were short on the way down, got out, it bounced, you got back in short, it then sells off again. You get out, and you've been waiting to get short again while it rallies about 4% from your exit there.
Got to atone for last year's sins somehow.
Forgiven, right? Okay. Also forgiven because I'm still up year to date. So like no harm, no foul, right? Like I've avoided I've avoided the stock market.
I've not talked this market into utter collapse yet. No.
Okay, so what do we make of metals here, though? This to me is the huge alarming thing. Gold IVR just dropped to its lowest level since February 2024. Volatility in the market when it disappears in gold and silver has been like that. What are those fish that come up before a natural disaster? Those ore fish, right? If there's like an earthquake or a tsunami in the Pacific, you see like fish wash up on shore, and it's like an omen because there's a great disturbance in the depths. Right, gold
the fish
ball
come up,
dropping.
The birds move.
Right, yeah, right.
Nature begins to signal a reckoning is afoot.
Now that the tariff war is over, or at least moving into a phase where the market doesn't believe the worst is going to happen, are gold and silver susceptible to one of those like -2, -3% down days?
I think we might be sort of groping at something like that here. Because
interesting terminology.
One of the more because it's very unsure. But look at this chart and then look at a chart of the euro. It's similar. Look at a chart of ZT, let's say. You start to get this strange sense that there's a near-term story here where yields and the dollar mattered, right? Yields higher a little bit, not outside the range. Euro lower, so dollar higher a little bit, not outside the range. And so gold is responsive, down a little bit. Not quite breaking down in a very convincing way, but certainly starting to flirt with that idea. Which is interesting considering the market was all happy that the Fed was dovish last week. You'd think this would be pointed the other way. But if this is telling us that the market already knew what the Fed was going to do, they just weren't prepared to front run it, and once the Fed said the magic stuff, they were like, yes, okay, good. They're still with us here. They're still on side. Then you get the correction in the dollar, you get the correction in the bonds, you get the correction here. If there's no more skating to do, if the market isn't going to extrapolate here and say, the reason stocks are going up is because the Fed is going to be more dovish sooner. No, it's more like stocks are going up because there's nothing else to do, because the news has paused, essentially.
There's nothing else to do. That's like why stocks are going up in 2020 and 2021. We're all locked at home. Like, what else are we going to do?
Yeah, there's nothing to do here. Like, okay, well, was the Fed scary? No. Are the tariffs more scary today than yesterday? No. Is there any data coming up? No. So stocks are going up because that's the stock's default. Meanwhile, everywhere outside where you don't have a bias as much, and you have relatively two-sided markets, they say, well, the Fed was as expected, divest of speculative capital. And so you get a day like this, where stocks are up, but all the other anti-Fed stuff is actually going the other way. And so it sort of tells you just how biased equities are on one hand. And on the other hand, it tells you that maybe if you were going to be a seller of dollars, it's time to wait. I cleared out all of my short USD exposure yesterday and today. Maybe it's time to wait. Maybe gold's going to pull back here and give us a better buy at lower levels. Maybe the bonds anchor here for a while, and it's a good time to either add or term out. And stocks are just going to give us an opportunity later. But all these non-stock markets seem to think that it isn't the Fed that's lifting stocks. It's just inertia.
Dylan, you're now back in Europe. You said that your view is that the U.S. economy is still slowing down, even if it's not falling off into a recession. What's the business environment and mood like over there now, a few weeks after we've seen this administration and German spending plans, the rearmament of Europe, etc.?
I mean, I think it's more optimistic economically than it's been in a very long time. I mean, it's setting up for a boom, obviously. Anytime new military is built from zero, or not from zero, but from a low level. And when you spend $1 trillion standing up a military, you get stock charts that look like that chart right there, or you see what's going on with the Italian stock market, or the German stock market, or the French stock market. And so, if anything, the situation right now, from an economic standpoint and the sentiment standpoint, matches exactly with the chart that you're flipping through, whether it's whatever you want to pick. There's Germany, all the rest of it. I guess, the question you have to ask yourself is, are the Europeans any more reliable than the Trump administration? In other words, will they follow through with all this spending and on and on and on? I tend to think that they will.
Yes. I'm planning a thing for macro money later this week. It'll be because of a lack of data to cover near term, is to kind of delve into the architecture of the Eurozone and talk about why the Eurozone really was created, even though it didn't make economic sense. How basically the absence of war is an exogenous economic good, and that this makes you want to accept a more imperfect economic setup in terms of convergence of economies and functioning of currencies and all these things that are always the kind of architectural issue with the Eurozone. Because if you can ensure that Germany doesn't roll tanks into France again, that's the greater economic win. That's why you see some of the early European communities be coal and steel and atomic energy, so very military industries that get tied up first between Germany and France, and more like France telling Germany, you will tie these up with us now, and then they expand wider. If that sort of logic follows, then the Europeans will follow through, because every time that there is a check on the defense of core Western economies, they do things like admit Greece when it isn't ready and tell Greece, fudge the numbers. We need to make sure that you don't slip back into dictatorship. Ditto the entire southern expansion.
In fairness, Goldman Sachs told Greece to fudge the numbers.
Yes.
Right.
But the message from Brussels was, it's okay, everybody. We need to make sure that Italy, Portugal, and Greece don't become dictatorships. They've just become democracies, so they're on our side of the Iron Curtain. Let's make sure we reinforce that. So when the time to bend the rules comes because of defense reasons, Europe tends to come through.
One of the reasons why the European stock market's going up, it's because it's really been a lost decade for large chunks of Europe. For example, if we go back to the calendar in 2008, France has a GDP per capita of $45,464 US. Spain is about $35,600 US. As of the end of 2023, France's GDP per capita was down to $44,690, and Spain effectively in the same spot, $33,500. So you've had a decade where most of Europe, GDP per capita has been going sideways. Stock markets rely on corporate earnings. Corporate earnings are a result of what? Money being spent, and GDP per capita was flat. Well, now it probably is going to shoot up. So if GDP per capita in Europe is going to shoot up because of all this spending, what does that mean for corporate earnings there? The charts tell the story. Obviously, the spending hasn't happened, but everyone's optimistic. S&P 500 closes out today up 1.65%. NASDAQ up 1.98%. The Russell, the leader, 2.29%. But that's it. Overtime is now out of time for this Monday, March 24th. We'll be back tomorrow, same time, same place. As always, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Of course, Tasty Live continues after this. Macro Money, Ilya Spivak coming up next.
See you there, everybody.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than, boom, trade like a trader. tastytrade. Make your move.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. And I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
If you missed the live show, here's our cherry on top weekly recap.
I got my Ted Lasso.
You actually have pants on.
Yeah, of course. I'm in school.
Huh, got it.
You're flexible.
It's cool.
Yeah. Oh, nice. You are pretty flexible. Let's see, get that leg up again.
Oh yeah, he's really. Right now, my other leg is cramping.
I believe that to be true.
We just ripped higher up to 50 points, and I just thought we would stay there, but
the thing the market does best is it keeps you very humble.
You get paid a lot for being right and you lose a lot for being wrong?
So give me, I don't know, a couple hours, and I will give you everything that you need to start trading options. See you soon.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Is it finally over? That's the question surely on the minds of traders today after stocks follow last week's positive lead with another rip. We're going to break down what is going on here and whether the spook that has played out in markets since the latter part of February, call it mid-February, for 4 weeks of dramatic losses is in fact over. Certainly, it seems like the markets are trying to find a way to say that, or if in fact there is just a reprieve here that's temporary before more pain is on the menu. That's what we're going to see if we can't divine here as we look at first why last week was what it was, and also why we might have a situation here where the path forward isn't as readily constructive as this price action might seem. So let's first and foremost look at the brass tacks here and review the performance. So clearly, the story is one that sort of writes itself. Stocks higher, yields lower. Needless to say, even if you didn't know anything at all, you might look at this and say, well, what happened last week? What was the one big macro catalyst? Oh, there was a Fed meeting. Ah, well, okay, stocks higher, yields lower. That means the Fed was dovish. And indeed, it seems like, as we talked about on Friday, the message from the Fed was, at the very least, sufficient for the markets to feel seen. There was a level of concern that there was a downturn in the economy, or at least the perception of one, as survey data, which of course is always early in these types of transitions, started to scream out, be it business confidence or consumer confidence, that something is going wrong, and the markets became spooked when the administration in Washington, D.C. said, we're not really concerned with this. The focus shifted to the Fed to say, well, if fiscal policy isn't going to bail us out, maybe monetary policy will. And so there was a desire for the Fed to come in and say something encouraging to the tune of, yes, markets, we too see that the survey data has turned south. We too are concerned, but we don't need to pull the ripcord at the moment. There is no need for any kind of an emergency. We can wait and see. But rest assured, if this survey data starts to transition into hard data, like, let's call it inflation or employment, well, then we're going to be beckoned to act, and there's nothing that's going to tell us otherwise. We're here to fend off threats to our mandates from wherever they may come. And so with that, the market seemed to have become reassured. And so stocks rebound after those heavy-duty losses in the prior week that capped the 4-week sell-off. Yields have a significant move lower, so bonds come up, and your sort of usual suspects cyclically respond here. Crude oil higher, 1.6 That would make sense if the growth scare has abated a bit. Gold up, albeit less than before, giving it a sense that maybe gold was front-running this. It's up 0.7% after the 3% rally in the prior week. And interestingly, the U.S. dollar comes up a little bit stronger against the euro, which comes in 0.6%, a little bit stronger against the yen, which comes in 0.5%. And so when you sort of look at gold and the currency markets, you get the sense that maybe they were early to the idea that the Fed would say what they said, and stocks and bonds just needed to wait and get the confirmation. But perhaps gold and the dollar were already on this kind of time before the announcement, because it seems more like they had their moves earlier, and with the Fed signaling to the market's pleasure, they took the opportunity to see some of that speculative interest get unwound and portfolios to get rebalanced. So all of this seemingly makes good sense in the context of what we saw. And of course, now we get a little bit of confirmation as the week begins, because here was the Fed's new updated summary of economic projections. Obviously, there was some shifting around of growth and inflation expectations, higher inflation expected, lower growth. And the way that Chair Powell explained this was, this is the thing that we would expect tariffs to do. We don't know what these tariffs will do, but historically, more trade barriers mean usually slower growth, higher inflation, all of which makes sense, just very baseline. If you get an increase in prices, people have incrementally less money to spend. Most of the economy is consumption. So if you tell people they have less discretionary income to spend because they're spending more on their typical basket of things because some of those things are imported and now they cost more, then there's less economic activity. Economic growth slows. So you get higher inflation because of the adjustment in prices, and you get slower growth because of the crowding out of discretionary spending by that rise. So not exactly rocket science. But the Fed was very clear that they don't know how these particular tariffs are going to work, whether the price adjustment will be a one-off after which things normalize, where people switch their consumption basket to things that weren't tariff impacted to the extent possible, and things level back out. So they don't know, and because of that, the upshot on the rates path is unchanged. 50 basis points on the menu for this year, from 4.4 to 3.9, and 50 for next year, from 3.9 to 3.4. We get the PMI data at the start of this week, and it gives us a bit of a growth bounce as the service sector finds legs for a rebound. We can see here meaningful pickup in economic activity growth in services, 54.3 versus standstill expected, 50.8. That's just a hair above this 50 boom bust level. Above it is growth. Below it is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see here manufacturing slipped back into contraction territory narrowly. Still pretty close to standstill, but narrowly under 50. And so in contraction territory by a hair, but certainly much worse than expected. Perhaps the front running of tariffs that was so loudly discussed in the PMI numbers, explaining this upswing in manufacturing toward the end of last year and into the beginning of this one. Perhaps it's finally run its course. But what we see most importantly is services, which you can see is the main driver because the composite index is pacing that and very much not the manufacturing side. Services is a much bigger component of the overall economy. You see that with the rebound in services, you also get a rebound in growth. Not quite back to where we were last year, but seemingly improving and arresting certainly this decline. And that seems to endorse the idea that there is no emergency, that essentially things are cooling. Clearly, this was steady growth, and this, even with the bounce, is now something of a cool-off. But nothing is catastrophic and nothing is falling off a cliff. And so when you look at what that has done to Fed policy expectations, we see that the markets and the Fed are now almost in alignment. Market has 58 basis points in cuts this year, 43 next year. So we're very, very close to being in line with the Fed's outlook of 2 cuts this year, 2 cuts next year. We're almost there this year, almost there next year. There's a slight bias in the markets toward more easing sooner. That's how you get 58 and 43. And of course, there's some rounding there. But that's how you get there. And that's how the total ends up being essentially 4 cuts over this year and next, which is exactly what the Fed has in mind. So this perhaps starts to explain why gold and the dollar are anchored, because we essentially have squeezed out all of the speculative juice out of the Fed story for the moment. The market and the official projections are a few basis points here, a few basis points there in line. And there's not a whole lot of juice. And now then the question becomes, what comes next? If what we're seeing in the performance here is that stocks are up, not necessarily because you have a forward-looking expectation of a more dovish Fed, but because you've realigned to what apparently the currency and metals market already knew. You've caught up here. You've had a one-off adjustment, as it were, in sentiment, and now you're basically looking on the other side. There is no crisis. Growth fears are present, but not an imminent hair-on-fire kind of risk. Well, then the natural next question is, what's going to be the catalyst that takes you in a different direction? And this week, that is a slim offering. In fact, it remains a slim offering until you get into the U.S. jobs report at the end of next week. On the menu for this week is U.S. PCE inflation data, the expectation that you are going to get 2.5% on the headline inflation number. This is, of course, the Fed's favorite inflation gauge. That would make it unchanged from the prior month. And looking at the core reading, which is really where the Fed's interest mostly lies, because needless to say, they don't have any agency over global energy and food prices. And in any case, we can very clearly see here that core services is where most inflation still remains at this point. There's a fairly steady wedge for housing, but this is really the business cycle right here. There you are expecting to see 2.7%, which would be a wiggle higher from 2.6% in January, but still below the 2.9% in December. So you'd essentially be going back to September of last year. Not exactly striking numbers. And in any case, the PCE numbers tend to be very well forecasted by the markets. Once CPI and the PPI index, consumer and wholesale inflation, once those are out, their components can be reconstructed into what goes into PCE, and the markets tend to be relatively good at getting these forecasts close to right. Rarely is there a sudden surprise. So this is probably not the indicator that gets the markets meaningfully spooked, but it could be a waypoint whereby after it, the markets feel freer to do whatever they were going to do. For what it's worth, U.S. economic data has somewhat anchored relative to expectations with a slight bias toward disappointment. We're below the zero line here, so it looks like at this stage the market still tends to favor outcomes that are rosier than what reality actually delivers, and so there's a slight bias toward disappointment. But because PCE doesn't tend to surprise much, and we are effectively now in something of an equilibrium between market expectations and the Fed, it doesn't look like we're going to get very far on this cumulative easing path this week. Unless, of course, something comes out of left field, as it always might. And so with that in mind, you might have more room for stocks to head higher, just because there is not an obvious reason for them not to. There's not a macro catalyst to fear, and there is apparently a favorable reading of what the Fed has suggested. We'll see if the story in bonds becomes anything other than relative standstill after this adjustment. The sense in gold and in the dollar, as we just said, seems to imply that the markets already had a bias going into the Fed, and that bias has mostly held, and so there's not been an impetus for change. So perhaps bonds are anchored here alongside these considerations, while stocks have room to drift higher just because their obvious headwinds have resolved until more data risk is on the menu. Meanwhile, outside of the U.S., more inflation data is due. We, of course, didn't just have the Fed last week. We also had the Bank of England meeting, which struck a little bit more of a hawkish tone. We are going to get CPI numbers out of the UK this week. The expectation for a bit of a pullback down to 3.6% on core, 2.9% on headline. And the key thing here, as was the case going into the Bank of England policy announcement last week, of course, was that inflation is stuck in a strange area. The really significant bits here that are sticky and refuse to give way are recreation and hospitality, which is a bit odd considering the UK economy over the recent months has been weaker, not stronger. And you'd think that what that would do is hurt those pockets of demand that are more dependent on discretionary spending, as recreation and hospitality would be. But clearly that's not the case here. Moreover, we've just seen here that the UK's version of PMIs, we got both the US and the UK numbers today, as well as some others. For the month of March, there's been a little bit of an upturn here. So just as there's been an upturn in the service sector in the US, so too in the UK, and so too this is the main pace setter for the overall economy. Now, the situation in manufacturing in the UK, absolutely abysmal, a very steep pace of contraction in March, going all the way back to the middle of 2023 for a reference point there. But the overall economy, powered by services, pointing higher. And the outlook on policy seemingly near the hawkish end of the range. Now, of course, there's still rate cuts that are called for here. So at level assessment, this is a dovish central bank. But we can see here we've basically been oscillating between around 45 basis points in cuts over this year and next, and 70 in a kind of range since the beginning of this year. And we're near the top of this range at 51 basis points. So it looks like we're biased to perhaps 2 cuts this year and then next to nothing next year as a sort of path of least resistance. And after last week, the Bank of England voting pattern ended up a little bit more hawkish than expected, fewer votes for cutting or for holding last week than anticipated. And the bias in the rhetoric seemingly suggesting, look, there's a lot of uncertainty. We don't want to cut into what could be an inflationary global trade dynamic. And of course, with this stickiness right here, the Bank of England is hardly in a place to do much cutting beyond what's already there, of course, considering that stickiness follows after this prolonged slowdown in activity. Perhaps it's the rigidity of labor markets that explains why. But when we consider what comes next, even if these numbers edge lower, it seems like the Bank of England doesn't have a whole lot more cutting that can get priced into the outlook. Moreover, if this PMI dynamic is to follow, then there's a little bit of upward pressure on service sector demand, which we can see clearly is what is the main fuel here. So you might actually end up with then an upside surprise on the CPI. We'll see what this does, because, of course, for the moment, the dollar has been mainly a creature of its own accord against other currencies. So the pound has been mainly pulled around by U.S. yields in its relationship with the greenback. And this extends to most currencies, save for maybe the euro, which has had the outsized rally because of a pickup expected in European defense spending around backstopping NATO. So we have a situation here where the pound, if it gets this kind of confirmation of standstill at best at the BOE, continues to track broadly with U.S. yields and the dollar, and to the extent that they're static, it'll be interesting to see where the balance of power shifts, making the pound almost a canary in the coal mine for the dollar this week. If the pound manages to rally, that might suggest that an independent lead is once again emerging for the dollar against other currencies, maybe give us the beginnings of the next leg of dollar weakness as a tradable idea. But if the market ultimately sees standstill on both sides of the Atlantic and opts to punt, then we might have to wait until the next big splash headline out of Washington, D.C., or next week's big macro data to put a lid back on stocks and inject some more interest in other, more two-way markets. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for watching. If you're seeing this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and my guest today, Professor Satoshi at Satoshi Heist on X. Give him a follow. Professor, how you doing?
I'm doing fantastic. Thanks for having me on the show.
Absolutely. Excited to have you here on the show. We've got a lot going on in the market. We're going to jump right into it. But before we do that, for anybody that doesn't follow you on X, maybe isn't familiar with you, can you give us a little bit of background, who you are, and maybe take us a little bit on your crypto journey? How'd you get started? It's always interesting to me to hear when people started and maybe what brought them into the space.
Yeah, sure. So I started working at a bank out of New York City in TradFi for about almost 5 years, a little under 5 years. And I was just, getting into crypto and Bitcoin in around 2016 timeframe. And I rode that insane bubble up to $19,000 is what we traded. I had thought that, just freshly graduated out of business school from NYU. I went to Stern, studied finance there, and I thought I was the next Warren Buffett. And I rode everything back down to the ground, unfortunately. But I stuck around, and I started trading options on crypto. And that's actually around the time when I left my safe Wall Street job to go full time into crypto trading options. And I'm happy to double click into the story, to the market, or wherever we want to take this.
Yeah, absolutely. What got you into the crypto options market at the time? Because if I recall, I don't know if, at least in the US, if you had anything like LedgerX at that point, and I'm not really super familiar with the Deribit history, but what was available to you at that point, given it was still relatively early stage? I mean, if we go back to 2017, kind of pre-ICO bubble and bust, as you described, there just wasn't that much out there.
Yeah.
How'd you get started into options trading?
You're absolutely right. Yeah, you're absolutely right. Actually, I started watching tastylive with Tony and Tom a long time ago.
Okay.
Yeah, trading equity options. So I always had a finance background. But back then we had Deribit, which really came on the scene around 2018 when I kind of discovered it, and really more so around 2019 is when things started to really pick up there. Now, Deribit, you're right. Back then, well, now, if you are a U.S. citizen, you can't really trade crypto native options. But back then, there was no KYC, and it was this kind of like website you just log in and you deposit all your Bitcoin, and that's kind of just how it went. Even Coinbase back then didn't have KYC when I first got onto Coinbase. But of course, now with the regulations in place and the regulator making sure everybody's identified. Now there are KYC rules, and yes, you're right. LedgerX was an option, and I think FTX had acquired them. Actually, I'm not sure what happened to LedgerX after the FTX implosion.
I believe it was sold off. Yeah, I don't know what it's called now, but there's still an exchange around. I'm not sure if it's available for U.S. users, though.
Yeah. But now at least there's IBIT options, I think, available. and the volume on IBIT options is actually growing quite significantly. And it's growing so fast that they actually increased the contract size limits. So I think, for all the tasty watchers and listeners, I think you can run your wheel on IBIT and generate more Bitcoin slowly over time. So I think that's an option.
Yeah, I love that strategy. I want to dig into that a little bit more. I mean, in terms of trading options, a lot of people will probably look at Bitcoin and think, okay, you want to buy longer dated stuff and just ride that upside. It's been a pretty decent performer, to say the least. But how do you approach the market? Are you a premium seller? Are you a buyer? Are you kind of trading all over the place? What's your strategy?
Yeah, so there's a few ways to view the Bitcoin market. It's matured a lot over time. I do like to call myself like a theta collector. That was actually going to potentially be my crypto Twitter name, but I thought that was just way too traditional finance for the crypto world. But I mainly like to sell options because of all the statistics that how 80% of options expire worthless. All those stats really spoke to me, and I felt that options in that way was a game that I could really win over the long run, as long as you're not maxing out your account and your margin, and you're doing it responsibly. I have some funny stories where I actually blew up a significant portion of my accounts, but I think the larger portion of my strategy is definitely selling options. And then there are definitely key moments in Bitcoin in particular where you definitely do not want to be selling options and you want to definitely be owning or buying, especially since it's such a catalyst-based asset. It moves based off catalysts. So you might want to be a little careful around some particular catalysts. Like we just had the strategic Bitcoin reserve. Actually, you might have been able to fade that move by selling calls, but definitely leading into it, I would not want to have been shorting any calls, for example. But if we have these crazy illiquid down moves, where Bitcoin falls 20-30% in one day. And, you could fade those moves with, short puts or short put spreads and things like that. So you got to pick your spots. But I think in general, I do tend to lean on the selling option side, whether it's calls or puts, ratio spreads, or even sometimes in some cases straddles. So it's a mixture of both. And I would say for the majority of time, definitely seller of options. Just don't want to be a seller of options when you got those catalysts in front of you.
Absolutely. Do you read into kind of the lower volatility levels that we're seeing as maybe a time you don't want to sell options? I mean, I think there's a couple schools of thought, right? On one hand, I get that you've got a high IV rank, you've got high implied volatility. I want to sell that, assuming that there's premium relative to realized. Maybe not so much if realized is moving at the same level or more. But I think there's also a view that I want to ride that declining volatility. Sure, you might want to sell a spike in the VIX in equities, for example, but it's quite often a lot easier to sell that break of, say, 20 as it moves back to 12 versus trying to pick a spot on its way up as it's expanding. So with that in mind, I mean, when you look at the current environment, and I think this is somewhat puzzling to people, I want to dig into it a little bit more, but you have seen these moves that you've talked about, right? You've got ETH down 50% in the past couple of months. Bitcoin's taken a hit. Anything outside of that with a smaller market cap is down much worse. But when you look at DVOL or you look at the Ethereum equivalent, and I think if I'm correct, that's coming from Deribit, but let me know if I'm wrong there. But you look at some of these implied volatility measurements, and they haven't necessarily spiked. I mean, when I look at Bitcoin volatility, I've got 47 on my screen right now, towards the low end of the range. Is this a point where you should be hesitant to sell volatility? Do you look at this as an opportunity? How do you think about the current levels of implied volatility and trading options here?
Yeah, it's really great that you bring that up. And I think a lot of options traders on the crypto native side are observing this. I think there's a few things at play here, but before we get into it, the funny thing is back then in 2018 onwards, let's just say, it used to be this widely accepted trade that whenever you see vols, trading 30 handle or buyer, just hand over fist buy, because there's going to be some move. And then if you see vols rip to like 100, sell. Like that's just a fade. Obviously, that's just a general rule of thumb. Now, I realized that Bitcoin spot could be moving intraday like 10K candles. Meanwhile, you have this phenomena where the implied vol is like it's literally just down only, right? So I think that's a very interesting phenomena that we're experiencing. Almost not that it's just only started to happen, but it's this new environment that I think vol sellers or options traders in general are starting to monitor. Part of me thinks MicroStrategy has something to do with it, because MicroStrategy trades at literally I think double. It's almost, I think the last I checked is like 90 handle. And just a lot more attention go if it's like people who, if you're going to long Bitcoin, why not long MicroStrategy? And so that in some form or shape is actually vol dampening for Bitcoin. And to your question about what should we be doing when vols are kind of like suppressed or depressed like this, there is a double-edged sword, because when you're looking at vols like this, so depressed, you're kind of hesitant to want to sell, because for fear of like a spike, and of course you get caught on the wrong side of that, then it's gonna be quite expensive to hedge deltas, and especially if you don't know why we're spiking, then you gotta unhedge, and then it costs more money to wind back down those deltas. So like I'm actually more of the opinion that if this is the direction, I don't mind selling, but of course you do have to size down, and I wouldn't be selling anything naked. For example, when we were lingering down in like the 77, 80, I was very keen on selling puts, but I wasn't going to be selling just naked puts. I would actually, for example, sell 75 and long 73 or some 70, some combination like that. Just because if you do get that spike, you want to make sure you're covered. Now, that being said, I do like fading, just like you mentioned, for the VIX. And I think that was a really good trade, because I think VIX is what, last I checked, like 18 today. It got hammered down, right? That's sort of what I like to do for Bitcoin too, especially when you have those events. I think the inauguration of the U.S. president was a great event to fade. And a lot of macro events, if you're really into selling near dated options for Bitcoin, tend to like revert down. It's almost like a free trade all the time, unless the macro data, like whether it's a CPI, FOMC, unless it's like egregiously out of line, usually those are free trades for selling like near dated vol.
Yeah, when I look at Bitcoin volatility or implied vols here, again, you've really been rewarded for selling any spike in there over, well, the last year or so, but we've seen that the trend for implied volatility over time has been a series of lower highs. One observation that we've made, or we'll talk about here on the show at times, is that there's a positive correlation between implied volatility, or more so even just realized volatility, and price. Obviously, that speaks to the asymmetry that exists here. It can only go to zero. A lot of times these tokens will trade with 200% plus vols. I think that's true, but do you see the same thing? I mean, is it true? Is there any empirical evidence? Is there anything that you've observed that shows that, yes, we do see a positive correlation between implied vol and price in the crypto markets versus that inverse correlation we typically observe in more traditional markets?
Yeah, there is. There is a positive spot vol correlation for Bitcoin. It's actually not something a lot of crypto options traders look at, but I do know a lot of my equity options trader friends, they do look at that. I don't know if I it's not part of my daily routine, but for sure if you're trading like the weeklies, which has been really popular in this tape because it's like a trader's tape, right? Every day there's news. Every day there's there's turns every almost every other day in this market. So if you're trading the weeklies, you do benefit from that positive spot vol correlation. And if you do want to pick a turn of the market, sticking to the weeklies is probably your best bet.
When you take a look at your process or kind of maybe what you go through as a trader, is there anything that you're seeing right now that gives you a sense of maybe where we're going? There's a lot of discussion as to whether we're at the very beginning of the cycle or that the cycle has already come and passed. I'm more that we're at the beginning of the cycle still. But is there anything that you're seeing in the market that kind of gives you a hint as to where you think we might be headed next?
Ooh. I used to be a subscriber to the cycle theory for Bitcoin. I think with the introduction of the ETF, I'm no longer really a strong believer of that. If anything, I'm a believer of the business cycle. And I feel like there's a big disconnect or dislocation right now between retail sentiment and institutional sentiment. Like, being in New York, I just see all the investment and all the interest finally, coming into crypto just, 2 months ago. And I know, prices are down 30%. That's quite normal. So there is this huge disconnect. And I think maybe it is an opportunity, but I do also understand that we're in a highly uncertain environment right now, especially with the tariffs and the growth scare, the macro growth scare guys are. I think they're evolving into recession. I think that's a little bit premature in my view. So the market's kind of all over the place. But as someone who's been in Bitcoin, I guess it's easy for me to say since I bought my first Bitcoin around $700, but I've been buying on dips and I feel comfortable holding this asset over a long period of time because I know the goal is, to trade at least, half the market cap of gold or at least eat into that market cap more, especially if you have the likes of Larry Fink going on Bloomberg and saying it is digital gold, right? So the job's not done. We're trading at 88K right now on my screen. So, we still got, $400,000 more to go, right, guys? So, and if you are, afraid of these, if you are afraid of a Bitcoin, down move to 30% down move, let's say it's 50% down move. That's the whole point that I trade options because, if you can generate 0.5% of your account equity per week selling premium, over the course of the year, you can minimize any drawdown by collecting those premiums. So I have a long-term view on Bitcoin, and I know that on crypto Twitter or some social media platforms they'll be like, oh my God, it's over, this cycle that we just topped, and there's nothing else to look forward to. Actually, I feel like in so many ways we're just barely opening up the gates on the regulatory side to onboard even more people into crypto. So it's a very good question because I feel like there's such a big dislocation in terms of the sentiment and where we are. I do understand risk markets, they ebb and flow with the narrative. And right now, the narrative is this growth scare, the tariffs. I feel like we're close to a crescendo of that narrative. And you saw it today. We had a huge bid on risk just in general. I'm just looking at equities ripping, crypto all ripping. Maybe we get a little bit of backing and filling, sure. But come April 2nd, when we get that tariff, the full scope of the tariffs, that uncertainty from the market is going to be, it's not going to exist anymore. So I think there will be some relief in Q2 at some point. Maybe we're starting to see, at least we can see there's an appetite to bid here, right? People are saying, we're going straight to 50K on Bitcoin. And I was like, I don't know if markets go straight down like that. But yeah, there's just this huge disconnect that I see. And I don't know if you see it too, but I remain bullish. I'm a perma bull on Bitcoin, long term, of course. Near term, maybe a little bit of uncertainty that we're working through right now.
Yeah, I tend to be as well. I think it's somewhat a function of being in this early. I think for a lot of people that have been able to experience the swings and you have a stomach for the volatility as a result, and as you mentioned, you get used to the fact that this is an asset that is going to trade lower or pull back by 20, 30%. That's totally normal. If you have something that can go up 2x, 5x, 10x, if you're looking at, with some smaller tokens, you are going to get larger pullbacks, obviously. So I'm with you there and tend to be a bit perma-bullish over long-term time horizons as well. When you look at the recent price action, and I agree with you, there's a really short-term memory in the market, in crypto markets specifically, and people tend to be very impatient. At least that's the sense I get on X. Everyone wants to get rich overnight, and sometimes that does happen, obviously, in some of these things. But, when you look at the recent market price action here, do you feel like, coming out of this turn here, do you think that the low, we'll call it about 75, do you think that that's in for now? Not that we couldn't retest it, but, how do you think about the market going forward?
Yeah, it's really interesting. I've been watching, basically I have SPX on one side and then the Qs, and then I have Bitcoin. They're highly correlated. I think I ran like this correlation on, I cleaned up, it's not, everyone has different R values, but this R value is like 0.8, which is basically, for lack of better words, is very correlated. And I think Bitcoin is a risk leader. It led the way down first, and then SPX, came down after, and it bottomed first. So the most interesting thing, in my opinion, before answering your question with my view, is that Bitcoin never went to the November 4th, 2024 lows, which is the U.S. election level that everyone's watching, whereas, SPX did.
Yeah.
Right. The Qs like blew through that. Tesla went down as much as Solana for like, that's crazy, right? And then of course, Ethereum went to I think it was 2023 levels, and then Solana went to August 5th, 2024 Japanese yen unwind level. And Bitcoin is is just hanging out. I was like, wow, how is this thing not, getting down to this November 4th level? And then what I like to watch is to inform, whether or not the bottom is in, is to look at the order book, spot order books for Bitcoin. And that order book was just lit up around that 75K level, 77K level. And that was, I actually, I took a short-term trade around there. And I do think, this bounce underway right now will have some backing and filling. I'm not sure if we're going to break to new lows just right away. I can't say that for sure, because there's just a lot of bids in that region. But if we do get, some backing and filling down to 84, 86, that could be a nice, higher low to play, because I do have a, generally I think more positive outlook for Q2 than most of my crypto trader peers, just because I think the growth scare is now becoming a recession, and I don't think the U.S. is entering into a recession. I think that's a little bit premature to call, because we don't see the data for that yet, and the way the market's overshot to the downside, I feel like people are just pricing in an imminent recession. So unless those bids leave for Bitcoin, I think this you should trust that 77K and look to bid any dips going into Q2. That's going to be my plan. I think obviously April 2nd, it's really path dependent on April 2nd for the tariffs. But yeah, I would definitely be buying dips on Bitcoin. And I don't know about the 66K calls and the 50K calls. I would definitely bet against that. But if someone said, "Hey, do you think Bitcoin could hit 75 or something?" Yeah, maybe it might just sweep underneath that low. But I'll be looking to buy dips going into Q2 as we close out Q1. That's for sure.
I've got to ask you about some of these dates and some tweets. I think, of course, everyone needs to go and follow you at Satoshi Heist on X. This show always goes by way too quickly for me. But before we run out of time, couple of tweets I want to ask you about because I thought these were really interesting. You got a series of dates: March 21st, March 24th, March 30th, April 2nd, April 17th. I think you've alluded to April 12th a little bit, or 2nd here, excuse me, a little bit. But what is significant about some of these dates that you've tweeted?
Yeah, I think options traders will definitely maybe catch on to some of these dates. So March 21st is OpEx, and then the 24th is the Monday afterwards, which I felt that we would see how the market wants to naturally move after all that gamma rolls off from that OpEx. And then March 30th is actually my birthday.
Awesome.
So I put that in there as kind of like a trick, a little bit of a trick. And then April 2nd is the tariffs, and then April 17th we got another OpEx. So I thought only options traders would understand that. So I think a lot of the people on the Tasty Show would definitely kind of read into those dates.
Absolutely. Well, and I think you're seeing some of that here today, right? Post what was a pretty large expiration when you look at the S&P. You get, when you look at the dynamic around dealer hedging and the flows associated there, you get some of that removed. And we saw this, I think, going back to March during, March 2020, I think, during the COVID period. You have that dynamic that maybe if it's only short-lived can really move markets in one way or the other. And here we're seeing, quite the move to the upside and with Bitcoin as well. So we'll keep an eye on those OpEx dates going forward. But one last question for you before we wrap things up. I think I'm in your camp here. We're going to probably take a little flack from the Army, but you tweeted about XRP. XRP fully diluted value right around, I want to say it's 250 billion or so, right there with ETH. Doesn't make much sense to me that these two are at par. Can you dig into that a little bit and explain why maybe the XRP market cap equal with ETH's market cap doesn't make sense to you?
Yeah, so I think I've been thinking about this and I've been looking at this chart because if you look at if you just look at the XRP chart, it looks like nothing has even happened to it. When you see the S&P and the Qs and Bitcoin and every other risk asset is just, the chart is murdered, right? And XRP is just kind of like hanging out in this like giant range. Any technician can just look at that and say, well, nothing's happening here, just chopping right after a huge move up. And I can't argue with that technician's observation because it literally does just look like it's chopping at the highs and nothing is happening to it. What doesn't make sense to me is that Ethereum has like $80 billion of AUM, or you can call it TVL, and all this DeFi activity. You got the L2s, Coinbase Base Chain, and Arbitrum, Optimism, and it's like, does XRP really deserve to be, trading at this valuation? Now in crypto, there's a meme that the crypto folks like to say, and they say, valuation is just a meme. And to some extent, that's true because you got these meme coins that are trading at higher valuations than some of the biggest crypto companies, for example. So I've been trying to short this thing because I just don't think that the valuation makes sense, and I think that there's some evil cabal behind the scenes like lifting up this price. So I make some memes about it. But I think that a liquid move from the election lows really, boosted the price, and it's just kind of hanging out about here for now. But it either means that Ethereum is trading severely in a severely depressed state and actually should, really, really go up a lot, or XRP, I guess, somehow magically became the number 2 like best crypto out of nowhere. And I have a hard time believing that it did become the best crypto out of nowhere. That's my view.
It's fascinating to observe. I agree with you. I mean, when this breaks, it's going to break, and that could be to the upside too. I mean, this trading at about a 200%, a little bit more realized vol, at least over the last month or so. But yeah, one that again could go very quickly, much lower, or could flirt with some levels that won't make any more sense than they do here today. But I also tend to agree with you. I think, in my opinion, really the trade that has yet to unfold, but if we are early in the grand scheme of things, I think ETH is that sleeping giant. It's just been left for dead, but we know how quickly that can change.
Yeah, I wouldn't be surprised if ETH trades like 2,500, 2,800 in Q2. I have this view that everyone wanted to sell, when we were in December of last year, every crypto native was saying, I'm going to sell in March to front run that April and that May time period. And then I'm going to just, sail, go to Ibiza and like party. And guess what? we December 9th, we got, hit just like straight down, like 50% down in like one go. And then January was not that, easy either with the executive orders. And then of course, now we have this tariff thing. So actually I feel like it's like, we're going to have it's the opposite of what we all expected. Everyone was like saying good Q1, and then I'm going to sell and like wait to buy the lows in August because of that seasonality. And now I feel like it's going to be, we're going to bottom, late March, maybe bleed into April, right? And we're going to bottom in April and run up to May and possibly even into end of June, which is like the end of Q2. That's as far as like my view kind of goes. But it's just kind of like this contrarian view that, Q1 is going to be bullish and then Q2, slow down into summer months. It's just, I feel like that's really going to play out. And it's going to catch a lot of people off guard too.
Well, I think we've got to have you back on the show at that point in another month or two here. Would love to have you back. We've unfortunately run out of time today, but it's been a pleasure, Professor. If anybody doesn't follow you that's watching, make sure to go to X, follow Professor Satoshi at Satoshi Heist. Great follow. And again, thanks for coming on the show this afternoon. Excited to have you on here and would love to have you back at some point in the future.
Thanks. This was great, and I look forward to being back.
Awesome. Well, that's going to do it for our show. I will be back on Wednesday. Until then, I'm Ryan. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Oh, yeah. It's Monday, March 24th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for another one of Tasty Live's evening shows, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. More on that in just a bit. But before we get there, we should say what's up to the people. Shout out to everybody watching on tastylive.com, as well as all of you watching within the Tasty Trade desktop and mobile applications. If you don't already have both, go get them. But if you want to be part of this little guy, nicely done, you guys in the booth. If you want to be part of that little chat box situation, head on over to Tasty Live's YouTube channel and start just bashing your face into the keyboard. I think that's how it works. The more active you are in the chat, the more you will spoof the Google algorithm into putting this little stream in front of as many people as possible. Speaking of the people, we should say what's up to the people. Brian Watson, a.k.a. the YouTube GOAT. How are you, my friend? Good to see you. Grumpy Mike, Soul Train, Brian, Adam Green, Firmament, Eric O., everybody. Shout out to all of you. Get those phalanges and metacarpals working, my friends. What a sick lineup we had today. It was a nice show with Ryan. What say you, people? You breathed a sigh of relief. Isn't it funny? All it takes is a little price action. All it takes is a little bit of a move in price action. We get out of backwardation, and all of a sudden, how quickly the narrative changes. More on that in just a second. But the S&P 500, my babies, put in a pretty decent day of work to the upside, up 1 3/4%. The NASDAQ really strong here today, up more than 2%, nearly 2 1/5%. The Dow Jones, your grandfather's favorite index, was up 1 2/5%. And the Russell was the outperformer, the little engine that could, up 2.5%. And that doesn't really tell the underlying story, because if you get indices moving at 2%, there were some big swings in underlying equities here today. Indy Tampa, I got you on your shout out. What's going on? Has much changed in the world? Probably not much, right? Everyone's just waiting on April 2nd, for the emperor to tell us what the new tariff scheme is, and whether or not we should be worried that the world's going to end, and whether it's the end of our capitalist experiment, or on the flip side, if the market will quickly adjust and we'll live to trade another day. I'm guessing it's the latter. But until then, it's going to be fun talking and speculating about what to expect as we approach that date. But the poker game we've been playing was, and I keep saying this, if you're getting sick of hearing me say it, let me know. But I just think we're in a bit of a poker game. 6,000 plus or minus 200 was the original value area and range. We were there for 4 months. You get sort of a increased distribution with sort of some of the geopolitical tensions, with some of the tariffs, the potential retaliatory tariffs, with honestly a weak economy and a yield curve which was reflecting a slowdown in growth and continued sticky inflation. I think you get a market that goes, I don't think the market is worth this multiple. We got a wider distribution. Let's trade at a cheaper multiple. We're now what I thought would be a range of 5,500 plus or minus 300, and what we said at 5,500 was, what's going to be funny is once we get back up to 5,800, vol's going to be gone. the narrative is going to shift. They're going to call it a growth scare, and and they're going to say all is well in the world. And the question really, we're going to get our second key test for the market. And the second key test is going to be once we get back up to this 5,800 level where we now find ourselves. Give me a little bit of a leeway here, 58 to 5,900. That this is sort of going to be another test area to figure out whether or not the market wants to continue to distribute here. I think 5,900, 58 to 5,900, you're starting to get the easy money is gone, right? Vol got smashed down from 30. If you were selling Vol at 30, I'm going to shake your hand, right? When everybody else is a chicken with their head cut off, they're scared and terrified. We don't know what tomorrow's going to bring, but we do know that historically we got paid pretty decent odds there to take a little bit of risk. But I think another key test here is going to be 5,900. So what do? I think a lot of the easy money in Vol's been made. Probably a decent amount of easy money in equities has been made. And the question is, do you start to lighten up or even fire against them as we approach 5,900? That is the question, my friends. Answer in the chat. I'll tell you what I'm doing, but do me a favor, answer in the chat. I'm also curious, over the last couple of weeks, I think on this show we've took some risk buying some materials, whatever the favored material was. Also a little bit of risk in like Tesla, scooped a little Nvidia too. At 108, Nvidia is just interesting. At 248, wherever we just were in Tesla, it was just interesting. And a lot of people, and we'll go too far down the Tesla path because I can always, in this day and age, it can always lead to a conversation I don't really want to have today. But at some point, man, I just used this in a conversation in email that the short term markets are a voting machine, and long term they are a weighing machine. And all the people that want to think about the world through the macroeconomic lens, it makes sense. You want to think about Tesla's growth and whether or not they're selling the cars, or how many cars BYD sold, or what the market share looks like, or what the removal of these sort of incentives at the federal and state level for this. I get it all. I got it. But sometimes this is a voting machine, and we're playing a game of poker. And today, it's the Pavlovian response, man. You got to imagine, like, for how many years now has this Pavlovian response of call buyers in Tesla, this gamma, wait until the right time to jump in there and just buy a shit ton of calls. And I don't think the Pavlovian response, I don't think it's been beaten out of the market yet, man. And so, you can make up whatever narrative you want to, whatever headline narrative you want to, that the market is perhaps easing up, or they're hoping that Trump is going to ease up on his tariff stance. You can make up whatever narrative you want to. I think at some level, these things just got really cheap. Come on, man. The stock cut in half in 3 months. That's a good enough reason. Any of you guys that bought today, if you were long today, did you go long because Trump might ease up on tariffs? I guarantee you, come on, man. No, none of you thought like that. You saw a cheap asset and you bought it because it was a decent risk reward position, and you saw vol collapsing, and you saw nothing spooky hitting the tape. Right? That's why I see these headlines. I read some of this stuff. I try not to. I'm not gonna call out the platform on this one, but stocks jumped Monday on optimism that President Donald Trump may hold back from implementing some of his wide-ranging tariffs. So the U.S. could skirt an economic slowdown from a protracted trade war. Give me a break. This is a comic book. Like, who? You really think that the world is that simple? You really think price action can be summed up and explained like we're in the middle of some soap opera? Give me a break. All right, let's see what you guys are saying. It doubled the 3 months before that. That's true. But it works the same way the other way. Jack Murphy, what's going on? Short vol represent. Hey VJ, been a while. How'd you fare in this drawdown? I'm back at account highs at this level. I'm not far. Maybe I'm a couple grand off account highs. I'm pretty close. So I did all right. And what I think, Jack, I really pressed backwardation this time. So I wish I could say I was like super strategic, and I had on some super smart relative value or basis trade, but I didn't. I just really pressed the big VIX futures when we were pretty deep in value in backwardation. And then, I bought up some of the materials, stuff like this, and they did pretty well. Let's see here. What are you guys saying? Don't you think we fade that last 2 days, April 2nd incoming, just like they warned us last time? I don't know how to think about it, April 2nd, honestly, Magic, because there's one part of me that goes, yeah, are you going to get some information that could, like some new information that the market may need a bit of time to adjust? Sure. But on the flip side, the only thing that would, as long as you get a definitive answer on what the hell's happening, the only reason, like, who said this? Knowledge is vol dampening or damping. Knowledge is vol damping. So us getting knowledge on the flip side of April 2nd is enough to remove a layer of uncertainty from the marketplace. So I don't look at April 2nd as some big D-Day for the markets. I'm not thinking about it that way. And I think the higher likelihood is you get a new date, which would suck. That's the worst possible outcome, I think, is that you get into April 2nd and what you're going to get is some pieces of information, and then you're going to get a new date to stay tuned for. And I think that's how this thing is going to work, unfortunately. And I think that's probably worst case scenario because there's a lack of knowledge and then there's a new layer of uncertainty added to the market. I'm guessing that's what they do because it's never easy. And do I think we fade the last 2 days? There's a part of me that thinks 59, this 58 to 5900 level might get a little choppy. But there's a big demand for assets out there, man. So let's see. I am lightening up on my deltas as we approach 58 to 5900. Like I had some upside, like E-mini S&P 500 futures options, like some dumb out of the money stuff. I think I had it's not dumb out of the money, it was in the money today, but they were the 5800, 5900 call spread or something like that. I bought when everybody was freaking out. And so I lightened up on some of that stuff today. I had some drag, so some long put drag in the portfolio I let go. So anyways, I'm decreasing the deltas just a little bit in the portfolio. I'm not outright short. I'm not outright fading this thing yet. But I'm lightening up. What are you guys doing? That's the funny thing, if you're going to wait for the all clear, if you're going to wait for everybody else to breathe the sigh of relief, you get a bad price. You know what I mean? At 5,500, everybody's scared out of their minds, right? Everybody's rushing for protection. Oh my God, GDP's negative 3%. The Fed's going to be hawkish. We're in a recession. Basically, people were saying we're in a recession last week. And you got a decent price. And now, if you wait until the all clear signal, when everybody's comfortable buying risk, I don't think you're getting as, clearly you're not going to get a decent price. So I think, I don't know, I'm not bearish yet, but I do think 58, 59 probably starts to get out of my value area where I want to add. If that answers that question. When it's down 20% and the index all in the money puts. Goldfish memory today, Victor. Buy. Maybe. I wasn't buying today, right? Like, we were adding little stuff last week. I wasn't buying today. I was selling some stuff. Not much. Or tariffs are the new healthcare plan. It will be announced in 2 weeks. We have concepts of a plan. Yeah, but everything rallied. Let's keep going. Bonds, you guessed it. Here's the interesting thing. We actually moved lower, and I think we're starting to see that long end lift a little bit, which I think the market is starting to move towards the Fed making a move in June. I mean, that's how I'm interpreting it. I don't know if I'm right, but it does look like the market is, the long end is lifting, which means we're slowly adjusting, in my personal opinion, to locking in some easing starting in June. And it's hard to know. Maybe just, people are rethinking their growth projections as well. That could be some of it. But yeah, the long end of the curve lifted a bit today. Bonds at 116 and change. 110 and 16, 30 seconds. And a pretty decent steepening over the last couple of days. Oh, look at you guys. You're putting all the stocks that you like. Where was all that last week? Huh? Now everyone's just throwing, yeah, exactly, McNutty. Long a bunch of Momo names because I like pain after a gain. So funny, man. I'm telling you, it's just a Pavlovian market. You cannot beat it out. People get a little bit nervous because we all know that this is just a big house of cards. But that's kind of the game. And even if even if the negative outcome presents itself, you know what they're going to do. You know what they're going to do. And I think that's so dangerous. You're looking at a screen full of moral hazard, my babies. That's what we are doing every day, is who can, which one of you is going to fall for the okie doke, and which ones are going to recognize that we live in a world of moral hazard. Am I wrong? Doesn't seem like it, man. Seems like, I guess the way I see tariffs, man. Tell me if I'm crazy. This is a mental model I've been working on. That sort of, we need to find revenue, right? We are basically like a country that's looking through the couch cushions trying to find money. Right? If people owed us money, we're going knocking on doors. I need my money, man. I need my money. So we're trying to find money anywhere we can find it, except a billionaire's pocket. So the wealth tax gets shelved. The Biden administration pretended as if they were going to go after rich people's wealth, but that got announced in some press release and literally went nowhere, collected dust on a shelf. But you also want to cut corporate taxes. So what do you do if you want to cut taxes and we still need to find revenue? You need like a value-added tax, right? You need a VAT, because almost everyone else has one of these things. But a tariff gives you more political leverage than a VAT. A VAT is just a flat consumption tax, right? Especially if you want to do something about inflation. I think this is why they keep landing on tariffs. And so the interesting thing is, instead of going and taxing wealth, figuring out a way to do that, what we are going to do is all of us are effectively going to pay a consumption tax, but through the lens of a tariff, so it gives our government a bit more economic control for leverage and negotiation. That's like my mental model about what sort of what's happening. I don't know if that's the right model, but it's basically like tariffs are a weird little, like an inverted consumption tax, is it not? Just a VAT in a different way that gives the government levers of power to control in economic negotiation. Sub-Zero says, I'm always 95% long, so I love these days, but I can't scalp, so I hate them too. Okay. You sound like an economist on one hand, on the other. Ask JD to find the money. How about that leaked Signal chat thing? I know that's just, that's like keys, dangling out keys, and we're all supposed to see that. We're all supposed to, we're all supposed to react to that. Who thinks that was an accident? You accidentally added a reporter from the Atlantic into a sensitive military conversation, or here's the thought: you wanted the Europeans to see that message, and that was purposefully leaked. Which one of those things do you think is true? That it just you randomly added a reporter from the Atlantic into your strategic military discussion, or you purposefully added a reporter so that you could leak this discussion and the Europeans could. You're sort of changing your foreign policy position, or making it known your foreign policy position for the Europeans is adjusting. Patrick Hennessy says the idea of a tariff moving the tax from the billionaire class to the W-2 class feels like a really accurate model. I think so too. Why the Atlantic? I know. That's also funny. Not using a secure line is I think it's funny that they're using Signal. Isn't that the guy that they want us? They wanted they want us to believe is a bad guy, and Signal is a bad product, and it's dangerous or whatever, and they use it. VIX down to 1748, a complete collapse, down another 9%. I suppose my question to many of you, and the one I'm asking myself, is, I think I kind of know the answer. I think we're in a place where I don't love the short vol play anymore, right? I'm not loading the boat on puts here either. I do think, we're right at 1748. That's right around the long-term historical average in terms of volatility pricing. So we're not super cheap. I wouldn't be mad at buying a little bit of downside protection on a portfolio now that vol is sort of inside or at its average, but it's not cheap right now. So if I was going to put an incremental dollar into the market here, I'm going to say something that's going to get me kicked off Tasty Live. I'd probably be buying cheap out of the money premium. Can't believe I just said that. To me, call spreads here, when you're approaching what could be like 58 to 5,900, starts to be a potential resistance area. To me, if I want to make the bet, an incremental dollar. Again, assuming you don't have chips on the table already and you're going, what do I do here? I'm not telling you what to do. I'm just saying for my own self, I'm thinking it through. As we approach what could be resistance area, maybe you break through it and we get back into our 6,000 plus or minus 200. It's possible. Or maybe we see a little bit of difficulty getting past this 58, 5,900 area. So I would probably take more risk-defined upside here. And because vol's getting a little bit cheaper, I'd probably move over to like the long out of the money call spread style. I know most of you guys probably hate that, but I'm just looking at vol and saying we're getting a little bit cheaper. I don't love the idea of selling it here, but if you're following tasty mechanics, and I know this, you're a blackjack player, you've got to play. You keep playing game theory optimal hands, right? So you're going to continue to sell volatility as volatility moves. You're not going to really look for expensive or cheap vol. You've got to keep playing the mechanics. I understand that. I'm a little different. Would you rather buy a weekly call or would you rather buy a weekly call or short a weekly call? A weekly call? Oh, that's a tough question. The funny thing is, it would probably be the same strike. So I would probably buy an out of the money call and sell an out of the money call. They'd probably be close. I don't know. It's kind of a coin flip, right? A weekly call over a week's time. I suppose right now I'd probably sell it. I probably want to sell an out of the money call. So you basically you kind of just expose the hypocrisy of what I just said. That's a good question though. I've lost over $1 million with purchasing options. Never again. I'm not here to change the tasty style at all. I take risk a little differently. That's all. And a style that works for me. Bitcoin, man, a real big move over the last, big on a relative basis, a pretty decent move from this weekend until today, which is nice. I think I had this conversation with Chris last week, and the question was, after you get down to 80, because I think some people were making the 75 call. Do you get down to 75 or 8 or 75 or 70? And sort of my view of the world is once you have a consolidation period in a highly or potentially highly volatile asset, what is the catalyst that makes a market puke another 10 grand? Because if you're not scared, right? If you're not sort of fast hands or fast money that's going to puke at 80, I don't think there's a ton of people in the market that will stomach 30 grand but then puke on 40. So I guess the way that I looked at it is if you like it at 70, you should probably like it at 80. Because what's 10 grand in Bitcoin? If your basis is 80 grand, what's 10 grand variance? Or 10 grand like vol. So I kind of liked it. So I'm long a little bit of the Bitcoin future. Not many, like 3 contracts, 5 contracts, something like this. I think so. It's probably time to sell some of that. But I want to stay long some Bitcoin futures deltas. Yeah, because I do think if the growth scare ends up being, if the market over rotates the other direction, in other words, if you go from being nervous about a growth slowdown and negative GDP prints, if you go from that, you can very quickly over rotate the other direction. And if a day like today, is day number 1 of a set of days where risk appetite sort of catches up. I want to be long that class of asset. I want to have exposure to that level of volatility. So I'm going to keep some long deltas here in Bitcoin. I just like the risk and reward here. I'm going to wake up one day and this thing's going to be down 20 grand and I'm, going to have egg on my face because that's how this game works. But if I'm going to take targeted risk here, I sort of like it here. And I think there's clearly an appetite built in here at 80. And everybody and their mom wanted to buy 75 if it got there. And I know that changes once you get there. Nobody wants to buy it anymore. I don't know. I like carrying some long deltas here. And I heard Ryan in the show before us. Whenever Ryan gets sort of this twinkle in his eye, he makes some sick calls, man. And he has this very nice handle. Hope I'm not saying it and talking out of school or anything. He's got a good handle on ETH. He makes some sick calls on ETH. And whenever he starts to look at ETH and think that there's value to be had there, I don't know. I start to get greedy. The only crypto asset that I actually want to ever trade is Bitcoin. But I've just me too'd. Oh, I can't say that. I've piggybacked. I'm an idiot. I've piggybacked a couple of Ryan's trades in the past. Should we be short, Vic? I think it depends on a lot of things, right? It depends on what type of vol you're carrying and everything else. But just as a binary yes or no, I think it might be a little early. I think it might be. I'm not yet. I like this area, 58 and 59, to put as an area we may slow down. But I'm not sure yet. Which is why I also want to carry a little bit of Bitcoin deltas in case I'm wrong and this risk appetite sort of rips, and we test 5,900. I do think I would love to see that. I would love to see this rip for a few days, and then into 5,900, and then I'd go. For me personally, I'm going to fade this thing. Nothing. BTO. You guys like that IBIT stuff? Whenever I can, I prefer the futures. I just prefer, I guess it has a lot to do with me being a degenerate and wanting the ability to manage risk at all times. I don't like being locked into a product for 6.5 hours, only 6.5 hours a day of risk management, especially if the underlying collateral or the thing this thing is tracking is 24 hours. So the jump risk or the gap risk in these assets, to me, I don't love that. And so I would rather either just trade Bitcoin straight out or use the futures for a little bit of leverage. I want to, real quick, we'll go over sort of the meeting probabilities here. It sort of seems a bit weird to do that on the flip side of the FOMC that just passed, but just to give everybody, I think I like to keep looking at some of these things. One, because if there's new people that haven't looked at it before, it's sort of an easy, quick way to see what the implied world looks like. And two, by setting up a habit, when you get deviations in some of these patterns, they can stick out and sometimes open up opportunities. So FedWatch aggregated meeting probabilities. I feel like I got marbles in my mouth. June 18th, 2025 is the sort of expected first cut in this new cutting cycle we seem to be embarking on. So we got another meeting in May. That one is not. We're not going to have an SEP with that one. Just a Q&A, press conference, a statement Q&A. And in June we'll get another SEP, and it looks like we'll have the first cut then. July looks like a hold. September and the second implied cut for the year, and that's about it. So we've been all over the board this year, or in the last 4 months anyway. We've been everywhere from one cut to as many as almost 4. They almost priced in 4 at one time. So we've been all over the board, and we're back at effectively 2 cuts for 2025, and that's probably about right. I think they're probably going to get 2 of them off. Victor, if vol is relatively low, would it be better to buy a put to fade or sell a covered call? How would you select the strike and duration for the put? So yes, if we can get another couple of days of a decent risk rally, and let's say vol gets below 17, I will look to buy downside puts, mostly put spreads. I don't buy them outright. I don't buy outright calls. I don't buy outright puts. I'll buy spreads. I'll likely do them out of the money, and I'll do them in the E-mini S&P 500 future, so ES. I do that because, again, same idea, nearly 24 hours, 6 days a week, risk exposure to be able to manage. And I also like the leverage that comes with those products. So there's a lot of bang for the buck. What do I do in terms of strike selection? I'm mostly like wrapping myself around 30 deltas. So in the same way that you sell, your 32 delta option or whatever, I'm around that ballpark when I buy this stuff. And most of the time, I'll tweak it just based on price. Just how much I'm looking to put down on the bet. And usually it's an all or none bet. So either I'm going to get the gamma, I'm going to get the move, and as soon as I get the payout, I'm going to cash them in. And if I don't get the payout, then it's usually an all or none. It's something I'm just going to hold, and they're going to expire worthless, and that was just drag on the portfolio. So usually I'll keep positive portfolio deltas, and I'll just have a leveraged downside bet. And so if the downside bet hits, it's just helping to offset the negative performance of the positive deltas. So it's nothing super fancy. I use the futures to get as much bang for the buck on a downside move as possible, and I make all or none bets. So stuff that if I'm going to buy it, I'm going to buy it in a quantity that I can lose all of it, let it work for most of expiration, and that's how I do it. Short MES contract if we get up to like 59. So sometimes I'll go short MES or I'll go short ES, and that's just to reduce my portfolio deltas. So if I've got a number, if I've been buying or accumulating stuff, or you get a decent rally in some of the things you hold, and the portfolio delta is growing or it's big. Sometimes if I don't want to capture that, if I don't want to sell those assets, I'll start adding on short MES or ES to try to lower the portfolio delta, or just flip it to negative. I don't flip fully negative very often, though. That's a tough game. I've been beaten up trying to do that in the past. nice. So let's see. I'll talk about, I wanted to at least bring up the yield curve, the 2s versus 10s, which is now 25. Oh, no. Let's refresh this. 30 basis points. There you go. The distance between the 2s and the 10s are at 30 basis points. It's really like measly, man. You know, some part of me wants to know, is this the new economy? Is this the post-COVID pandemic response economy? You know, a 30 basis point spread between the 2s and the 10s. That's not exactly a rockin' economy, is it? I've said this before, but the average between those things are 100, you know, the long-term average since I think the 70s. I think the 2s were introduced in the 70s. So if you take the data on the 210 as far back as you can, I think the long-term average is about 100 basis points. That's typically where we are. And we're nowhere close to that right now. 30 basis points. A couple of underlines just real quick. I am long a little Tesla. They paid us a little bit today. Long a little Nvidia, not much. And that chart looks sick. That does not look like a healthy chart. Microsoft, I have not bought yet. Of the Mag 7s, let me ask you this. Of the Mag 7s, which are the ones you think are most interesting here? Or do you think there's more pain ahead? Like if you had an incremental dollar, would you go to the Mag 7s right now? Or would you go to the Russell? The market answered that question today, and it gave the edge just a little bit to the Russell. And I wonder, if you had an incremental dollar, would you go to the Mag 7s, which are beaten up, in some cases 50% off, or would you go to the Russell? The rest of the world trade still looks good, but it underperformed a bit today. FXI up 0.2%. Let's say VGK was basically flat. EWW, another one on the radar, which is Mexico, was up to 0.2%. All of this, to me, this stuff is interesting. If we could get in this pocket, you could unwind sort of the first 3 months of bullishness in the rest of the world trade. So I think if U.S. equities catch a bid here, what I'd probably like to be buying is some of the rest of the world ETFs that would probably go on discount in that scenario. Or if they don't go on discount, they'll underperform on a relative basis. So I think that could happen in the next couple of days. You see a little bit of an underperformance or distribution in some of these rest of the world trades. And I don't know that theme is over though. So I think in the next couple of days, that might be my short-term playbook, is look to pick up some of these things if they can go on discount. If the U.S. can catch a little bit of a bid, maybe we can get the rest of the world a little cheaper. Long-term, it's an Nvidia. Short-term, probably Tesla. Russell is what I'm continuously keeping long deltas in, says CM. Look at you guys. A lot of excitement for Russell deltas here. I'm not knocking it. But in that case, let me ask you this. If you're long Russell here, is it just a short-term risk and reward play, or is it actually a bet on a stronger underlying economy? Because I feel like if people are going to be betting the Russell, they're not really betting a bear market. They're betting at this point that whatever damage needed to have been done to stocks has been done, and that the adjustment for a deceleration in growth has been made, and that you're on the other side. You're on the other side of a growth scare. That's sort of implicit to that buy. You could just say it's short term and they're really cheap relative to the others, and I would say, okay, I get it. But I'm curious, all you people that want to get long Russell, tell me, is that really an underlying bet? A stronger narrative than the one people were selling last week? This thing nobody's talking about, by the way. Like, I get that Tesla, I get that Tesla gets all the headlines, and I get at one point it was all about the proximity to power and how you price that. Now they've taken all of that out and they're bombing his cars. Bro, the world changes so fast. It makes your head spin, But quietly, a lot of some of these Chinese EV companies are just they're going nuts. Nobody's talking about them. I don't get why. Same thing with, this is supposedly a Chinese drone company, EH. Another one that's up like 100% within the last 6 months, and nobody talking about. Let's see. VJ, I'm long Russell because it dropped. I buy every 10 points and sell out for 20. I get it. CM says it's the index I'm choosing to keep long deltas in rather than be completely short. Okay. So it's your relative. It's sort of what you're offsetting. I got it. So what are you short? NASDAQ or ES? Weekly view of IWM points towards short-term outperformance. Paul Thomas says, yes, I had to worry about my car being lit on fire during lunch. Dude, what is going on in the world? I wish I could, maybe not me, just anybody, somebody much more talented and with a greater knowledge and ability to reach out to people. I wish we could just talk to everybody, you know what I mean? I wish like one day we could have this day where we teach everybody like an intro to game theory. And all you do is you sit everybody down and it's just you go over the prisoner's dilemma. It's all you do. Everybody, all working class people in the whole world. And you just go over the prisoner's dilemma. And you go, the reason why the outcome is predictable is because of the incentive structure of the game. I make the assumption that you want to minimize your time in jail, if everybody knows the prisoner's dilemma, that you want to look out for your short-term best interest. But if you become predictable only in a world where you are looking out for your own rational self-interest. But if you care about your neighbor as much as you care about yourself, you actually you change the dynamics of that whole game. You become less predictable. And I think the difficulty of most of the difficulties people find themselves in is because their actions, once you set up the incentive structures, their actions are predictable. And the way to sort of work through this is to be unpredictable by caring about your neighbor as much as you care about yourself. You can change the dynamics of the game. That's step one. Then step two is you have to act as a collective. That's the other way to beat or optimize your performance in the game, is you have to figure out how to act as a collective. And what people keep doing to themselves is they artificially subdivide themselves within the collective. Your power resides in numbers, and you keep dividing yourself down to a color or a this or that, and you literally diminish your optimal power of the collective. And I feel like it seems like nobody knows this. You know, it's why it's the concept behind a union. But then once you have a union, the institution decays and it becomes self-interested of the people who benefit most at the top of a union. And sort of we have these mechanisms to change outcomes, like a government. In a way, it's helping to act as a collective. But these institutions have decayed. And it's not hopeless, but I can tell you what's not going to change anything: setting a Tesla on fire. You know what I mean? It's like this emotion is, you don't like the outcome of this game, and it doesn't feel fair, and it doesn't feel like you can get ahead. It doesn't feel like you can work your way towards better education outcomes for your family. It doesn't feel like you can buy a home. But setting a Tesla on fire or being mad at Elon Musk, if it's not Elon, it's another Elon. You get it? Like, if it's not him, it's J.P. Morgan. You know what I mean? If it's not him, it's Jeff Bezos. Like, the game, you're getting mad at the wrong thing. You're directing your energy at an individual and not a system that's designed that he will be replaced with another one. And without an understanding of game theory, man, like, these conditions are locked in. They're perpetual, and they get worse. All these assets are sitting in the hands of very few people. And the magic of compound interest is that those assets are going to continue to grow. You know, but the pie is only so big. So you're gonna pay for the compounding of those assets through an erosion of living standards, and that's what we're seeing, man. We're seeing an erosion of living standards to pay compound interest, in a way. I know it's not direct, but I'm in this. And the way to fix that, my friends, is not getting mad at a player in the game. You have to understand the game and then play optimal. You know, you have to optimize your play in that game. And I get really concerned that that's not going to happen, you know? And part of the problem is I think we're all looking around going like, hey, somebody should do something. But it's that we're just comfortable enough to not want to sacrifice our own individual comfort. But if we all do that and we all act in rational self-interest, like, you can't change the game. It's a sick little thing we're stuck in. Sorry, I don't know where I went there. Elon is interchangeable and the scapegoat. Exactly, man. Interesting take. The Jesus strategy mixed with unpredictability. And here's the other thing I think about, Vic. The way to fix it is 0-point energy and robots building. I wish. Oh man, I forgot what I was just going to go somewhere. It's probably for the best. Problem is, you are 10,000 times smarter than these protesters. No, I don't think so. You know what it is? At some point I figured out how to snap myself out of the matrix. At some point, I figured out that, oh, you know what? These people are just paying for my opinion. At some point, I figured out an algorithm is just something that connects my attention to the highest bidder. And so whoever's got a product or a message, whoever has the optimal bid for a product or message that will keep my attention, that's what I see. It's not what I like. You know what I mean? And so it's just this optimal way to get people to think and accept certain ideas and thoughts. So when I see everybody moving as a collective and doing dumb stuff like eating a Tide Pod or doing some dance, I don't, I see that as basically an algorithm that trained its animal. You know what I mean? And when I see people going out and like lighting these cars on fire, I just see people they're trapped in a matrix. Man, they get some message that tells them to be mad at somebody. And then, that anger gets channeled into unproductive behavior instead of political organization. You know what I mean? It feels better. You go light a car on fire and then you go to work the next day. I'm sure there's some, I don't know, do you feel better? It's not going to change your circumstances. In many cases, you get caught, it's going to make it much worse. And also, by the way, congratulations, all of your car insurance is going up. Congratulations. But I do think this whole game is about checks and balances. And I think if we don't understand that how the wealth inequality has completely changed this game and not for the better, I don't think we're headed towards the optimal societal path right now. Anyways, somehow that was why you should be long Russell over the NASDAQ. Good night, everybody. I care about having my car lit on fire because it's a Tesla, yes. This is where I was going to say. That I think it's interesting. Like if I'm a billionaire, right? I don't really have a political ideology. I'm going to support the candidate that is going to advance my business interests. And so one side of the equation, capital, that's the way they play the game. They supported Biden. Now they're in many ways supporting Trump. But it comes with a trade-off, right? I give you this money, or I give you this coverage or favorable coverage. I give you whatever this is in exchange for whatever. But like people don't do that. They don't go, we need to use the two-party political system to advance the interest of the people. They go, I am on this team and everyone on the other team is wrong. And it's like, bro, why would you do that? Why would you not use both sides of the political aisle to advance your interests? Like, for instance, if I'm capital, I'm going to use the Republican Party to lower my taxes, and I'm going to use the Democratic Party now to give myself cheap labor. I'm going to use you both. And why that's only built into the capital side of the equation, why labor doesn't figure out playing for a team is the dumbest possible. It's so stupid. It's not optimal play. Anyways, all right, let's keep going before they boot me off the air. Let's keep going before we get booted off of. Oil, I'm still doing nothing with oil, but I'm long energy stocks. I am long energy stocks. And this is a weird thing. I said this before, that there was a point in time when I would just buy the material. So I was long crude oil, I was long copper, I was long gold, I was long silver. I want to say there's something else, but like long the actual underlying futures. For whatever reason, gold seems at a weird extended price here. I don't really want to be long gold, though I'm bullish. I don't want an incremental dollar in gold. I'd rather play the miners, which in my personal opinion are cheaper. I like copper. not because I think it's expensive now, so I don't really want to be long copper. So as a proxy, I'm long China, and I'm also long FCX, and I've been buying FCX, and which paid off a little bit today. Same thing with crude. Like, I'm not long crude, but I'm long a handful of energy names. I like all of the material spaces, but I just can't bring myself to buy the underlyings. For some reason, I think the equities are a better risk reward play, and that's been my story, and I'm sticking to it. They should protest the Federal Reserve instead of lighting Teslas on fire. Yeah. So anything that demonstrates, an understanding of the root cause of the problem. You get what I'm saying? Like, okay, protest. Okay, your government refuses to implement a wealth tax, whether you think that's a good idea or not. They're cutting expenditures. Okay, so if that means they're going to cut social services or cut education spending or cut whatever, and you don't want that to happen, well, you don't just want to keep paying for it without an offset. Okay, because if you keep doing that, you're devaluing your currency, and your wages are stagnant. So you don't want a devalued currency. So what you want is an offsetting tax. You don't want that tax on you. So what you say is, okay, if I don't want my expenditures to go down, and I want to keep them, but I don't want them to murder my purchasing power, you need to go do this other thing, which is, whatever, wealth tax or whatever. But there is no demonstration of an underlying understanding of the root cause. I think I've beaten this thing to death. I think I've beaten the Tesla thing to death. I don't know why. I really hadn't planned on talking about it that much. Anyways, FCX, I'm still long this thing. It probably is a little bit extended in the short term. It wouldn't surprise me, actually, to see a little bit of a pullback in materials. The appetite, I was actually surprised at how materials performed today. Not surprised, concerned is the better word. Concerned. They all ran after consumption and tech. So when there was risk appetite, they didn't go buy up the materials. So I'm kind of concerned about that. Well, it was Target before Tesla. Don't tax you, don't tax me, tax that fellow behind the tree. I've never heard that one. Yeah, man. The thing is, it gets worse before it gets better. And that's the thing I keep thinking about. That it gets worse before it gets better. Because you have to hit this point where people are willing to play game theory optimal. And at that point you don't have much to lose. That's why you're willing to play it the game that way. What do you guys think about Nike here? I think I would touch this thing. There's some part of me that wants to get in there and sell some puts just because it's bombed out, but I do not like this. Like, I see all the people that would have been buying Nike going, I'm not buying $200 shoes anymore. I'm not buying, $300 vests. I think they got a real problem. But that's reflected in the price. So there's some part of me that looks at Nike at 65 and I go, God, man, should we be selling puts here? Should we? No, they're not paying anything. $1.50 for the 65 puts? No, thank you. This thing is dead. Nobody's going to touch this. I'm old enough to remember Target being boycotted. Yeah. I'm not gonna go there. I've got tons of thoughts on that subject, but I don't. I'll have to do that on some other network or on Rumble somewhere. The SEP, just as a quick reminder, we got a new SEP last week. We covered this last week, but just really quickly as an update, 2025 real GDP dropped from 2.1%. They dropped it to 1.7%. And they also raised unemployment just a scotch from 4.3 to 4.4. PCE inflation, or they raised inflation expectations as well, 2.5% to 2.7 on headline, and they raised it from 2.5 to 2.8 on core. Ilya and I had this sort of same thought. I think my knee-jerk reaction is I don't believe that. For some reason, I don't know. I think their inflation expectations may be a bit overstated for 2025 and probably understated for 2026 and beyond. They did not move the Fed funds rate from their December projection. So 3.9% is where it stayed. So approximately 2 cuts. We showed you what that looks like June and September. And then another 50 basis points in cuts next year. Then, between 1 and 2 cuts in 2027. Not much of a change in terms of their rate path over the next couple of years, which I find somewhat surprising. So the interesting thing is, if you took inflation in isolation and you just told the market you're the Federal Reserve and it's your job to maintain price stability, and you told them inflation was going to go up and you're not going to do anything about it, which is effectively what this says, right? Like inflation, my projection of inflation is higher than it was in December, but also I'm not going to move the Fed funds rate. What you're saying on paper is that it's transitory, and they use this word as well. But I've called this in the past miraculous disinflation, stuff that just takes care of itself on its own. I don't know that that's how the stuff works, man. But for some reason, we keep having to go through these exercises and learning that lesson. But people would freak out if you just told them inflation was higher and you're not going to move your Fed funds target. And so you got to have an offsetting risk, right? And your offsetting risk is unemployment's going to tick up and growth's going to fall out of the bed. And then there's an appetite for continuing to lower rates, even into a world where you see the sticky inflation nearing 3% at some point this year, which is absolutely wild. But that's where we find ourselves in, and people start whispering the stagflation. Not with the capital S, but with the lowercase s, effectively stagflationary conditions where inflation is increasing, but growth is decreasing. And that is a good environment for gold, historically speaking. But even if, let's say they're wrong, and this is the conversation I had with Ilya, even if they're wrong. So let's imagine that for whatever reason, inflation doesn't accelerate to the extent that they've put on this piece of paper. So you have inflation that's staying where it is, or potential disinflation and decelerating growth. If that happens, that's actually a good environment for gold as well. And so I think you still, if any of one of these two things are true, you still have what looks like a supportive environment for gold, which is why I still like the miners. I don't like gold at 3,000, just because I don't feel like you're getting value. But the problem is the market is just not giving you a point of entry. It's just not giving you a discount, a meaningful one. I hope you know what I mean. There's a couple down days here and there, but a 5% down day in gold is not that uncommon. And a 5% down day in gold at 3,000, you can get a 150 point down day. And we got like a couple of days of 50, 60 point moves back in the end of February. They bought it up like this. And now I'm sort of kicking myself. If you remember, we were having conversations about what to do with gold as it was making that break. And I'm like, yeah, if I can get it at, what did I say, like 25, 24? No, I think I said 20, below 25, I think I said. And it just ran away. But the good news is Newmont Mining, my friend. Newmont Mining is still, I don't know what to call it, cheap. A lot of that discount that was built in there, a lot of it has sort of, we've seen a decent rally here. I still think maybe you get another $5 out of this thing to the upside or beyond. Who knows? But it is the stick in the mud of all the miners. If you look at the rest of the miners, GDX is sort of the miners ETF. If you don't want to pick one, you can go to this thing and it'll just spread your money across a basket of these gold miners. But the problem is I don't think there's much discount to be had in this ETF. It's trading at highs in sympathy with gold, so you're not really getting the discount play. People don't love Newmont Mining business. Their performance, I think recent M&A activity, there's lots of reasons to not love it, but I think eventually a rising tide lifts all boats, and I think that's why I keep talking about this one. I also like the fact that I'm going to say a lot, we are starting to see a little bit of a turnaround in some of the nuclear stocks, which have had a nice haircut off their highs. DeepSeek, basically, the DeepSeek story was the pinprick of the AI hype, and it had a material impact into how you think about nuclear energy as well. So that got repriced, but I do think at $40 or nearing $40, CCJ is an interesting pickup here. So I added some of that, I think, last week. Not much. Maybe I added 5% to the position, I think. Just keep buying. That's the majority. That's the majority of my positions, everybody. Now I'm going to go worry about my covered calls that are lower than the basis of my shares. That's the worst part of putting on collars. The worst part of putting on collars is that I tend to think if I've done it, then the rest of the market has done it too. And if the rest of the market has done it, then the market is short, like the participants are short calls, which means the market's long those calls, which means every time I do it, I know we're going to blast through my short call strikes. Every time. And then I'm just wrestling, trying to roll them up higher. Paul Thomas says CCJ call to put ratio 2-to-1. Yeah, beware the gamma squeeze. It could happen. All right, my friends, I'm going to see you back here tomorrow. I believe we're on the regular schedule this week. I might be wrong, but I think we're on the regular schedule this week, which means Chris Vecchio is going to be joining me tomorrow, I believe. So make sure you tune in for that one. Hit the like button if you haven't already. Subscribe to the channel. If you want to follow me on Twitter, which I've been super active on as of the last couple of weeks, You can follow me at Victor Jones. The Owen Jones is a 0 because I like to be difficult. I've been tweeting more about inequality lately than actual risk positions, just because I don't think there's been much to do. 2 weeks ago, I was talking about screaming about being short vol. But that's really the only big position I had, and then buying up some of the materials, which you guys know about. So I'm more interested in filling my time with speaking about inequality. So if that sounds interesting to you in any way, shape, or form, or you want to debate me on any of those topics, feel free to follow me there. I will see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Till then, peace.